Thanks everyone for coming. Great crowd, good weather. Nice to get out and about a little bit. So it's my privilege to welcome you here and introduce our MC, host of the day, which we're really excited to have, Max Armstrong. Max is one of the most highly regarded and widely followed ag journalists in America. For more than 40 years, his broadcasts have been viewed and heard by millions of farmers, ranchers, and consumers across the country. He's a recipient of numerous honors from trade associations and farming organizations. And I will say, we won't hold it against him this morning. He is an alumni at Purdue University. So I had a lot of jokes set up for when we won, and I wasn't thinking we were going to lose again. So kind of shot my speech for the morning. So we'll slide past that. But he is an Indiana native. Grew up on a grain and livestock farm in the southern part of the state. With his longtime partner, Orion Samuelson, Max is the host of This Week in Agribusiness on television, as well as Farm Progress America and Max Armstrong's Midwest Digest on radio. He also continues as a weekend voice on Chicago radio powerhouse WGN, where he's been heard on ag broadcasts every week since 1977. So he's president of the National Association of Farm Broadcasting and just a fantastic ambassador for ag. So please welcome Max Armstrong.
Yes, I walked in and I heard some woman say, "Why, he's wearing an Illinois tie. He didn't go to Illinois, did he?" I hope I'm not violating some regulation. Yeah, what do you think about this, huh? And I ask you, if the shoe had been on the other foot, how many of you would be wearing a black and gold tie today? Yeah, I will be honest with you. I was a little concerned last night in that first half. When Purdue was down about 9, I was listening to Brian Barnhart's play-by-play, pardon me, as I was traveling down the road, and I thought, I may have to phone in my participation. It wasn't looking good. But I got in here and I behaved myself during that last half of the game. I'm looking around to see so many familiar faces, and it's good to see you. Saw many of you last summer up at Rantoul with a half century of progress. How many of you were there? Yeah, quite a few. Where were the rest of you anyway? You didn't want to sweat, I suppose, and didn't want to walk a lot. But what a great event we had up there. And by the way, I want to thank Premier for helping make that possible, for being one of our sponsors. Jack Murray, where are you? Jack, is that you over there? Come up here. I want to give you something. We do appreciate very much the fact that Premier helped make this event happen for not just this area, but for people actually all over the United States. I met people from 36 states at the show last year. And in fact, there's a guy from North Carolina who comes up here. His name is Madison Hedgecock. And if you Google him, he was the fullback for the New York Giants when they won the Super Bowl. And if you Google him a little more, you'll see he's a farmer down in North Carolina. Well, he's bringing his boy for the show next year. But Jack, I wanted you to have one of these special belt buckles. I had some made up. Darius Harms, founder of the show, had several made up a few years ago, and nobody could find them, Louis. So I had some new ones made up, and they have numbers on them, and I wanted to thank you. I want you to have one, Jack, and thank you for helping make the event possible. Tim, I have one for you, too. Stick that in your pocket there, young man. I would be wearing one, but I need a new belt. I've got to find a way after the holidays to get a new belt here eventually. I don't know what happens during the holidays. I actually reverted back to long underwear a couple of weeks ago, and I hadn't done that in quite some time. But it was reminiscent of, we went through a cold blast a few years ago, and I was in pursuit of long underwear. I was traveling down Highway 41, down the west side of Indiana, and I got to Terre Haute. True story. Maybe you've heard me tell this. I went into the Tractor Supply looking for long underwear. And I went up to the girl there at the cash register, and she didn't look like she had grown up on a farm. She didn't have that look to her at all. And I said, "Do you have long underwear back here?" She said, "I don't know if we have them in your size." I was a little larger then. She said, "They're back there on aisle 4. And I went back there and looked. Sure enough, there was extra large size long underwear, and they were camouflage. I took those home and my wife said, why does anyone need camouflage long underwear? What do those hunters do out there? So I kind of reverted back to that for sure, to look back. There's a big anniversary coming up. Next year, we will, when we have the half century of progress, that'll be the 20th half century anniversary of the 20th first show. Let me rephrase that. The 20th anniversary of the first half century. We only do it every other year, so it'll just be the 11th show, but it's also the 100th anniversary of Farm Hall next year. And I was looking back through the records, I guess it'll be about the 120th year of the co-op here, because it all started with the Savoy Grain Company in 1903. Did I do that math right? It'd be 120 years. Yeah, Purdue guy. I figured that out. So it'll be a big year for a lot of celebration, to be sure. And you think back, I guess one thing that I really respect about the longevity of a co-op such as this and an event such as we have where we pay tribute to American agriculture, there was a lot of blood, sweat, and tears along the way to make all of that happen. There were a lot of difficult decisions that had to be made on farms and in cooperatives during the years. And I think we should never lose sight of those folks who went before us, who showed up at one meeting after another and during very difficult times. And we look at the landscape right now and we think, oh my goodness, where are we going to go? What's going to happen here? Well, some of the folks with a little snow on the mountain can recall other challenging times too. So hopefully that will be some inspiration to us. We have 3 panelists coming up, and they're going to be presenting, taking a look at this input situation, grain market situation, and fuel. But afterward, you'll have a chance to ask some questions too. And so we'll give you that chance. You can text some questions. Tim's going to be fielding some texts to give me some additional questions to share with our panelists as well. So I want you to know you will have that opportunity if you care to. I'm going to invite Brian Domi to come up to present first. Let me tell you about Brian. Darren Domi, my feeble mind here. Darren is a principal and managing partner of Powerline Petroleum, also known as Powerline Group, for the last 19 years. Darren specializes in price and margin risk management, hedge strategies to the petroleum industry. Darren also provides innovative marketing programs and specialized fuel contracts like fixed price or cap price programs. Darren also provides market intelligence, insight on forward pricing, and timing recommendations for seasonal contracting periods that add value to the petroleum marketer and the end user. And he works with a lot of interesting companies that you might know, actually. Darren's customer base ranges from convenience store chains to truck stops, petroleum resellers, construction firms, transportation fleets, municipalities, and other end users and consumers. And with everything in play at this time, I think you're going to find it very interesting. Welcome up to our stage right now to take a look at this interesting landscape. Darren Domi. Darren, come on up.
Wonderful. I'm glad everybody can see that. Wonderful introduction by Max. I think it's almost like you wrote that for me, Max. That was wonderful. Very wonderful. I'm actually a local farm boy. I grew up south of Champaign here, about 25 miles in the small town of Broadlands. On a grain and livestock farm myself. I still farm just maybe a few hundred acres, 15 head of cattle, so still into it. But my life is trading petroleum. And I've got a great presentation of information I want to share with you here today. But first I want to ask a couple questions. How many of you here today are 35 and under? Raise your hand, just so I can tell how many here. Okay. How many here are 55 and over, or 50 and over even? Let's say 50 and over. All right, perfect. You'll understand my jokes. Okay. I know this might be a little bit hard to see. Wow, there's a screen in the back as well. I didn't see that earlier. What I want to show you, this is the energy or the S&P Goldman Sachs index for the energy complex and other commodities. The energy complex on average was up 59%. But if you look at diesel fuel, and if you look over here, diesel fuel was up 64% on the year, gasoline up 67% on the year for 2021. If you look at the agricultural markets and livestock markets, they were up 23%. First thing I notice is, man, one of my inputs is up 3 times what agricultural and livestock are up, right? Because diesel fuel is up as much as 64%. Then you come here to January. Is this fitting on the screen okay, guys? You come to January and diesel fuel was up 19% again, just during the month of January 2022. Gasoline up 16%. First 5 days of February, diesel fuel up 8.2% again, right? The market continues to move, but I think you need to take note in here. Even though I'm talking about petroleum, crude oil and diesel fuel is the canary in the coal mine anymore when it leads to inflation. And the reason being is when the economy starts to take off, more goods and products have to be shipped and they need diesel fuel, right? So then you start seeing diesel demand jump, ending stocks want to start getting down, price starts going up. So it's a good indication of what's going to go on in the economy. And I know many of you have even heard the phrase, Dr. Copper. The copper market always has a tendency to lead the economy by about 6 months, right? If you want to really kind of see where we're going to go with the economy, in the past, we've always been able to look at the copper market, and if it's started to head up, usually the economy's following it 6 months later. If it's already starting to head down, you kind of know the economy's going to slow about 6 months after. Really what's caused a lot of these problems, and I'm going to take you back into the past, and I'm going to bring you up into the present, and then I'm going to take you into the future and kind of tell you where I think this diesel fuel and gasoline market have potential to go to. Now, as farmers, pay close attention to this. You're probably thinking, okay, I only burn maybe 5-7 gallons of diesel fuel per acre a year. It's one of my smaller expenses, but I'm going to show you just how much it's gone up per acre cost. But what's also what you need to pay attention to as we go through this. Everything that I'm showing you and has happened in the petroleum market could almost be the exact same playbook you will be looking at in corn and possibly soybeans in the next year. All right, and I'll explain why as we go. Obviously, in February 2 years ago, 2020, COVID hits. What happens? They do a massive lockdown and travel restriction. Well, you've got all these refineries running wide out, right? So what do they got to do? They've got a massive overproduction. They got to slow the things down. Crude oil actually trades to a negative $40 a barrel in April 2020, right? Producers and refiners around the world have to aggressively cut production. Now that negative $40 a barrel never should have happened. Okay, that was, is there anybody in here from the CME? Good. I see their sign over here across the street. The Chicago Mercantile Exchange never should have let that happen. For us guys that are over 50, you guys remember the Ferruzzi soybean deal, 1989? Okay. The CME came in and said, look, we're not going to allow the Ferruzzi to try and corner the soybean market. We're going to go and tell all the FCMs, the futures clearing merchants, to tell all their customers that they have to do an orderly liquidation to liquidate 10% of your July soybean position every day for the next 10 days so that on the last trading day, there'll be little volume left and we'll have an orderly liquidation. Just to not spend too much time on this, there is a ETF called USO, US Oil, that was massively long 30 days going into the end of expiration of the May crude oil futures. CME calls him up, probably a young guy. Hey, what are you going to do with this position? Well, we're going to take delivery of it. Okay, bye. Probably hangs up, turns around, tells his superior, they said they're going to take delivery of the oil. Well, it was a very massive, large position that they thought they were going to try and take delivery of in Cushing, Oklahoma. Okay? Well, when they start looking at this, they don't have enough shorts in there that are willing to give them the delivery, right? All right? Well, the CME knew this. Even 15 days prior, the CME never came in and ordered an orderly liquidation by saying to every FCM and even all these big trading firms, we want you to liquidate 10% of this position or 10% of your position every day for the next 10 trading days so that we can have an orderly settlement on the last day. They let this go clear to the last day. This huge hedge fund was long, had to start selling out all these positions, and hence just forced this market into a negative number. All right, so thought I would have a little fun explaining that. At the same time, now you've got on May 1st, here comes OPEC Plus. They got a joint venture going with Russia. They decide, let's cut 10 million barrels a day of oil production. They had to do something at that time anyway to get the excess oil off the market. They had nowhere to go with it. They were filling up every floating ship on the ocean. Every nook and cranny was being filled with diesel fuel, gasoline, jet fuel, kerosene. There was storage that we haven't seen filled in 15 to 20 years being filled back up during this time frame. Then as the summer goes on, we start kind of getting back to normal a little bit. August comes along, and here comes a hurricane. You've got Marco and Laura that kind of had some effect in here and shut down some of those hurricanes again, tightening up the supply again, right? Takes them a while to get back up. Now, here's where a lot of our problems start. November 2020, new president-elect pushes an aggressive green environmental change. This administration has tunnel vision. Must be done overnight. In other words, they want this change to electric cars, carbon credits, environmental, solar, wind, and they want it done, and they want it done now. And so the inauguration was what, January 20th? January 21st, Biden comes out and halts the Keystone Pipeline. January 27th, the Biden administration comes out and halts all the oil and gas leases in the Gulf of Mexico. You got to think, these massive rigs out there produce some large quantities of oil out in the Gulf of Mexico. It wasn't until June of last summer that another judge came back and said, I overrule this. It has to be an act of Congress that votes on this. Okay? So then he overruled the first ban. Then the Biden administration goes nuts and just starts approving oil drilling leases out there like crazy. 3,500 leases. That was 900 more leases in 2021, or in their first year, than what the whole Trump administration did in their first year. So then the administration, so then just 2 weeks ago, January 27th, another U.S. judge comes out and he says, I'm going to null and void every lease that's been done out here. What? Null and void? What are you talking about? He goes, we didn't take into consideration the environmental problems, of the foreign countries and what it's going to cost to them and the foreign ships coming in and out of here, hauling out this oil. What? So now all these drilling leases have been banned again. And at the same time, when the Biden administration's press release comes out, they call it, well, it's because we've never been in this kind of environmental crisis before. So, here they are explaining it away that we are in an environmental crisis. How many of you feel we're in an environmental crisis? Yeah, I didn't think so. Okay, I highlighted this next one in yellow. February 2021, a year ago this month. What happened? Major southern cold snap goes deep into Texas, causing a massive power spike in demand. Overloads the power grid and it crashes. Basically, hell freezes over down in South Texas. You've been down there in the summer. When you're going to work, you take 2 shirts. One, you wear from the car to the office building, right? Because you're a sweaty mess time you get in there, and then you put your dress shirt on. Otherwise, you always got the big armpit soaks right there, okay? That's when you're working in Houston. So, all right? Now, pay attention to this number, okay? 32% of the nation's refinery capacity loses power, all right? We're talking Beaumont, Texas, Port Arthur. That's right here in the Louisiana-Texas border area. Then you go all the way down south to Houston. And remember, this is hotter than Hades in the summer, I just told you. But all the way down to Corpus Christi, which is right down here in the curve of Texas. Everything just went out at the click of a switch. That's not good if you're in the refinery business. Why? Because when you shut those down and they all cool immediately, a lot of those pipes fill up with carbon, fill up with tar, fill up with soot. What do you got? You got a lot of computer programmed valves and switches that need to be fixed and replaced. You just can't turn the switch back on. Fire up, Jim! It ain't gonna happen, right? It's gonna take 30, 40 days to get those refineries back up and going, and you have to bring them up in layers, all right? The reason this is also important to you at the start of your fertilizer problems, a lot of these refineries are on 2,000 acres to 2,500 acre plots down there. Right next to them is all these massive chemical plants, Bayer, Sygenta. What are they making? They're making your chemicals, your herbicides, your pesticides. There's urea fertilizer plants down there. When these things go down, it happened to be in the winter, it slowed up all of what you were going to need for later that spring and summer. Okay? Big start of the change for fertilizer. All right, bottom one here, early 2021, investment banks. I'm talking Goldman Sachs, Bank of America, Morgan Stanley, all right, are told by the Biden administration to stop lending to fossil fuel producers. I guess this one's picking me up. Stop lending to those fossil fuel producers, which is Shell oil drillers, or anybody else that wants to come in here and try and expand or build their fossil fuel business. Keywords and phrases now into 2021: clean energy, renewable fuels, biofuels, sustainable, carbon neutral, carbon credits. Everything you turn on last year hits you in the face, see whether it's in the news, social media, or on the internet, is clean this, clean that, bio this, bio that, right? Okay, so what is happening? One more, let me bring up another thing. Next slide, I'll tell you some more. May 7th, hackers hit the Colonial Pipeline. Okay, a lot of you have heard the term Colonial Pipeline, but you've never seen it. You don't know where it is. It's buried underground. Here's a real nice map of it. Built right after World War II. We needed it. You know why? Because we were taking barges from Texas and Louisiana around the coast of Florida and up to the Northeast to fuel all of our people and military bases and everything on the East Coast. Well, the Germans kept sinking them, right? So the idea is let's build a pipeline all the way from Texas all the way up to New York, New Jersey. And that's when this thing was built. All right, understand this. This thing carries gasoline, diesel fuel, jet fuel. It supplies 45% of your fuel needs along the eastern seaboard. 36 billion gallons a year. What happens? Dr. Evil comes along and hacks it and shuts it down and says, I want $5 million. I mean, anybody ever see the movie The Spy Who Shagged Me? Austin Powers, Dr. Evil, $1 million. His son makes fun of him, right? You almost got to make fun of these guys. $5 million. FBI actually says they got it all back. It was in Bitcoin, but not one arrest has been made. Kind of funny, huh? But now look at that pipeline. You tell me, was that not a national security issue? And in the press conference, Biden says it's a Colonial Pipeline business issue. I mean, you had your military bases, and you don't hear this on the news, but you had military bases running out of jet fuel during this time period, as well as marine fuel, and we were getting short on distillates for trucks. Now, what's that tell you about our national security? Man, if I was China and Russia, what an easy hack these guys are. Not to mention, all I got to do is hack the Texas power grid again, and I can knock all those refineries out, put them back in the dark age, and I can take that whole East Coast in no time. California, we've already taken, probably is what they're thinking. So, the supply and distribution continues to tighten. It's snowball effects. BP stands for British Petroleum. Up in Whiting, Indiana, sits right there at the corner of south side of Chicago and northwest Indiana, is a massive 450,000 barrel a day refinery up there. All right? These guys are Europeans. Their mentality is when all this hits, and they think everybody's going green. Volkswagen says they're not even going to make an internal combustion engine car after 2030. So how can I continue to put money into this massive refinery if everybody thinks they're going to go to electric? So now BP says, man, we should get this thing sold, or maybe start closing down parts of it, because they can't afford to sit there and continue to put money into this massive refinery, right? Now, this BP refinery supplies the Chicago, Wisconsin, Michigan, Indiana, and parts of western Ohio. All right? There is two more up there in Joliet. There's an Exxon, and there is one other. Okay, then we just go to August. I put that in there because this refinery, if they close, and they close early, we've got some serious problems. And to even confirm this, They even called the state of Illinois and said, you might be wanting to expect maybe 6,000 job layoffs. That's how serious they are and were about selling off this refinery or closing it down. So you're not getting the investment back into these refineries that you once did. All right? August 29th, this one's important. Another highlight in yellow because it also affects your fertilizer. A Cat 4 hurricane, one of the biggest oil and chemical hubs is in Louisiana. This storm comes in here and hits these big refineries, and again, they're several thousand acres, sits right next to them is all these chemical plants. They're making your herbicides, your pesticides, they're making your fertilizers as well. And when these things go down, it's an issue. It's a big issue. You took down Royal Dutch Shell, okay? I put the whole name up there because we used to know Shell Oil as a U.S. company, but it was bought out by Royal Dutch. It's now a Netherlands-owned company. And I got to tell you, these Europeans have an extreme attitude towards going green. Okay? We sit here in this room, and with the crowd, my age group, over 50, we're sitting there going, what? You know, what are they thinking? But you're seeing the pattern here. They're shutting down our old refineries, and companies are saying, I can't afford this kind of investment if these administrations are going to continue to push things in this direction by 2030. Late August 2021. The market, now understand this, now it gets to get into August, and your big companies, your power entities, are starting to look and say, I got to start getting my winter natural gas bought. Let's finish getting our coal stockpiled. How much is that electricity going to be? What happens is they realize, oh my gosh, inventories are really low. So now, here comes a mad rush going into winter. European natural gas and coal prices surge. China tells their companies, secure supply at all cost. Those are their actual words published. All right. Now to us older generation, to you young guys, you may not even understand this, what those kind of terms and phrases mean. But you think back on anybody that's ever been in a war or even gone to war somewhere, or even think back and lived with parents that came home from a war. When another country says, secure your supply at any cost, what's that mean to you? By hook or by crook? Or are we going to have to take another country's petroleum supply? Kind of like Japan was trying to do? World War II? I don't know. But I mean, those are kind of scary words. You sit here and think about it. United Nations. Everybody knows the United Nations and who it's controlled by. It's told not to make any new loans to fossil fuel development, no matter what third world country needs it. Let's talk about Guyana, Nubian, or another African nation. They just discovered millions of barrels of oil in an oil field. They want to develop this field. They want to build some refineries. They want to build their own economy in their own infrastructure. But you know what? They're not going to get the money from the United Nations. Why? Because the U.S. is the biggest money developer of the United Nations, right? The biggest loaner. So now they got to go out and they got to seek this money from private sources. But there's a lot of countries out there, other than the U.S. and Europe, that aren't even thinking going green like the U.S. is. And it's going to give us a major uncompetitive edge, folks. Okay, now, European power prices. I'm in the fall, and I just mentioned this. European power prices surge so high, fertilizer and chemical plants shut down. China halts phosphate exports through June of 2022. CF Industries, a major nitrogen and fertilizer supplier in the UK, shuts down. Why? I'm going to show you a chart on the next page. Because their natural gas got so expensive, it needed to be diverted to heating homes and running businesses that were more pertinent than fertilizer. Well, I know every farmer in here says, world's got to eat. You think you're going to be in business and you're going to be able to put out a crop because the world's got to eat? If you don't have diesel fuel, nobody's going to eat. November 2021, here's what's also kind of interesting. I'm laying on the couch, it's 8:30 at night, going into Thanksgiving weekend. One of my own Indiana petroleum marketers calls me up, and he was really upset. He says, I just came out of a local bank meeting. And he says, they will not approve me to expand my bulk plant in southern Indiana area. He's wanting to put in some more storage. He's wanting to build a little extra storage in his bulk plant because it's getting harder and harder to get fuel, and he wants to grow his business and supply more of his farmers and agricultural and local business in that area. But what's the problem? His local bank, now this is a hometown bank, has gotten woke, right? Okay, they won't make the loan. Now it's not only nationally, but for what's gone on for almost the last year, now a local bank doesn't want to loan money to some of their own locals. This could be a serious situation as things go on. Here's a U.S. coal price. Coal is actually traded in the over-the-counter market on the Chicago Mercantile Exchange. This is an OTC chart of coal. If you can see this chart, or even see the one in the back of the room, by April, May of 2020, it was at $50 per metric ton. The coal market just took off and surged, and right at the end of the year, it was clear up to $227 a ton for coal. Now that almost makes it profitable enough to start digging it up anywhere, right? Coal's, you can develop any field for $227 a ton. The next chart over, this is the European natural gas price. And if you can't see this, this is $25, $50, $70, $100, $125, $150, $175. In May of 2020, we were down to about $4 per MMBTU. And, mostly the European price normally traded, not much over 10 on a regular basis. But now things start getting tight, and, there's something out there. Stocks get a little tight and the market goes up into fall, right? Right here you are in the September, October timeframe. Everybody's making that mad rush to secure their needs. They get some of it bought. The market starts to come back down because we rationed off a lot of supply. A lot of big chemical companies, fertilizer companies even in Europe all shut down, started to ease the pressure a little bit. But then what happens? Russia has to sneak up into the Ukraine again and start making threats like they did with Crimea. Is that how you pronounce it?
Crimea.
Crimea? Yeah. All right. So then Germany says, okay, right in here comes Russia. Germany comes in here, and the United States. It was mostly on, the Biden administration's support. And even in yesterday's comments, Biden says to Russia, you will never get this Nord Stream 2 pipeline done if you go into the Ukraine. And so, right in the midst of winter, and I think that's why Russia planned to do this right before winter, natural gas now goes from basically $75 per M clear up to $175. Just to give you a reference, our natural gas price today on the futures market in the United States is just trading $4.10. $4.10. And our average power bill for the month, for this last 30 days, the average American is probably going to pay about $720 for the last 30 days, including this cold part of February, for a power bill. Think about what this is going to cost, all right? To these businesses, it's going to cause them also to shut down, right? Which is continuing to tighten up the supply and cause the inflation. All right? Now, I'm just going to point on this. I mean, you're farmers. You probably really don't care about refinery capacity, but I got to point this out because it all adds up. In the last 2 years, and mostly last year, we start shutting down an awful lot of refineries. Pennsylvania, Philadelphia, Pennsylvania, 335,000 barrels. Covenant, Louisiana. This is exactly what Shell Oil was looking for. That storm Ida shut down 220,000 barrels. Phillips 66 in Louisiana, 255,000 barrel a day refinery. And I might add, that one was kind of, I would expect that. That refinery's 50 miles south of New Orleans, right? It got swamped out during Ida, and it kind of gets hit. That salt water's kind of rough on it. So now it's just going to be turned into a storage terminal. Same thing with Covenant, storage terminal. Same thing with Philadelphia, storage terminal. But they're not producing. All right, then you got California, which we know nobody cares about. Oh, by the way, California, I have read earlier this week, is passed a law, or is getting ready to pass the law, that they will not allow any more new oil wells to be drilled in the state of California, and that they're working on a package to subsidize the people that already have wells, and then they're going to get them closed. Okay, so what's that going to do to the refineries there, right? You know, if they're going to be able to stay in business, they're going to continue have to import fuel or oil, you know, into the state. All right. The very bottom one here is probably hard for you to see. Let me tell you about Holly Frontier, Cheyenne, Wyoming, New Mexico, and the one in the Dakotas, North Dakota of 19,000. They're small refineries, but up there in those areas, they're extremely important to the agricultural industry. They sit right there on the east side of the Rocky Mountains and supply a lot of those wheat regions and western livestock regions. And, you know, it continues to tighten up the distillate market in those western Midwest states. Deer Park, you can't see this probably on the screen, but this is Exxon's Deer Park, Texas refinery. It's outside of Houston. It's a 250,000 barrel a day refinery, which they just sold to Pemex, which is the Mexicans. All right, now start picturing this. Well, he just told me that we're no longer allowed to have a lease on 80 million acres in the Gulf of Mexico to drill oil. So, you know, we're not going to be able to produce oil in the Gulf of Mexico. But the Mexicans are still going to be able to drill all the oil they want on their half of the Gulf of Mexico, right? So now they just own this big refinery. Well, let's just put this oil on barges that we produce in the Gulf. Let's just barge it on over to the Houston Ship Channel. We can sit there and run it through our own refinery now and put our own product on rail cars, or put it on barges and send it back down into Mexico. These products, a lot of it may not even make it back into the United States. It's probably going to head south. Why? Mexico's not on the same pace as we are at being woke and being on this green environmental exchange. I mean, you got to sit here and say, look, it's too costly to go overnight into this, you know, non-fossil fuel environment. Now, I put this pie chart up here because it's important. This tells you everything that is made from 42 gallons of crude oil, which 42 gallons is in a barrel, right? The orange is what you need to look at. So out of a barrel of crude oil, 23% of it is diesel fuel. Well, if you add up these refineries, and let's just add up those 4 big ones on here, four big ones, you're going to get a little over 1 million barrels a day of refinery production that's been shut down. Okay, so if 23% of that goes to just pure diesel fuel, that's 230,000 barrels a day. There's 42 gallons in a barrel. So now you're looking at almost 10 million gallons a day of diesel fuel of lost production, right? 30 days, that's 300 million gallons of lost diesel fuel production, right? So now you've got to find another country to produce some of that because our distillate demand is going through the roof because of the strong economy. It's got to be imported probably, right? And if they don't import enough or get it into the mid-continent areas, things are going to continue to get tight. But when you look at this, if you continue to shut these refineries down at this pace, you're going to have a lot of problems because it makes kerosene for jet fuel. All right, now as the economy picks up, let me also throw this out at you. As the economy picks up and we start needing more jet fuel this spring and this summer, what if I was running a refinery, what I'm going to have to do? I'm going to have to tweak my diesel fuel production level to make more jet. Market's already tight. But you know what, as a refiner, I don't care. I'm making $27 a barrel, man. I'm making more money now. And even though it's BP and Royal Dutch Shell with the European mentalities and the European boards that are trying to tell them to get out of the fossil fuel business, BP had a record profit of $4 billion just in the fourth quarter alone this year. And where's it come from? Refining fossil fuels. All right. But yet, their board wants them out of the fossil fuel business. But here's all the things that come out of here. Asphalts, petrochemical feedstocks. That's what makes your plastics. That's what also makes 90% of the rest of your car, even if it is run by a battery. And then, You've got propane. What about all your lubricants, all your oils, all your grease? All right? Kerosene. I wanted to point out here of what it takes to put out an acre of corn in terms of diesel fuel equivalent. Now, this is from Iowa State University. It's based on a national corn yield. So, folks, everybody in this room is probably producing, 200 plus bushel of corn, 230, 250. Double these numbers. 125 pounds of N for commercial N fertilizers, right here in the red, and a 5% drying points, that's in the green, and 175 bushel corn. All right. Now, you're obviously producing more, but this is a national yield. Majority farmers burn anywhere from 5 to 7 gallons of diesel fuel per acre. A lot of you are trucking corn out all winter long, trucking soybeans out all winter long. You're trucking it into the bin at fall, back out. You look at your diesel fuel, 2,000 acre farmers probably burning about 14,000 gallons of diesel fuel a year. All right. So this goes to show you how important and how much diesel fuel it takes of an equivalent. I know a lot of you are only concerned with this portion down here, which is probably a little bit closer to maybe to 7, and some of you may surprise me. All right, here's the diesel fuel. I'm bringing you into the current now. Diesel fuel futures market. The blue line, focus on the blue line. Is it starting to move yet? It's not supposed to. Okay, your price is at 288. All right, that's March futures, 288. Here's April, 275. Here's May, here's June, July, August, September, October, December. The red line, that's January 2023 futures. I'm just pointing it out so you can see where the diesel fuel market is trading for the year of 2021. Many of you just call up and say, hey, what's diesel fuel at? Bring me out some. And you think it's cheap, it's gone down. This is the price you're always seeing, folks. But just like the corn market, just like the soybean market, the diesel fuel market trades every month out for the next 4 years. So here's what every month is valued at in the blue line for the next 4 years out. This very last line, that's January 2026, and the diesel fuel price is clear down here around 226. Okay, versus a 288. So that's 60 cents a gallon cheaper in the next 4 years. But when you have a market like this, and the spot price is up here and they stair step down, this is called an inverted market. Traders, we call it a backwardated because we're used to looking at a carrying charge market in the old days. Now this is an inverted market. When you have an inverted market, and you farmers know this, when you put corn in the bin in fall, you always believe you're going to be bringing it out at a higher price come January, March, even in July, right? Normally, the corn market is in a carrying charge market. It pays you to cover the cost of your storage, interest, and insurance. When I'm in an inverted market, who's going to cover my cost? If I put fuel in storage up here at this price, next month it's worth $275. Next month it's worth $264. Then as time goes on, I can't afford to store it. I'm going to lose money every month. What this is doing is it's killing the incentive to store diesel fuel. All right? So now it's even harder on the supply chain and the distribution chain because nobody can afford to store it, right? And many are choosing not to renew their long-term storage contracts. That has to do with the inverted market. That also has to do with the current administration because they're concerned. Why do I want to continue to store fuel if everybody's pushing for this green environment? The orange line is an average price for the year of 2021. Now, I'm going to throw this out there. You need to maybe talk to Garrett Burns here at the co-op. You could do a fixed price contract for the balance of the year at the orange line versus maybe the spot price. I'm not sure how it's going to look in the cash market. Okay, but this is what my end user customers will look at. If you're a trucking fleet, we'll look at these things. Oh, well, maybe I want to do a 24-month, or I want to go in here and lock in 2023. Large construction firm comes in here and he's working on a big overpass or bypass down and around Dallas, and he says, I'm going to be moving a lot of dirt, 20,000 gallon a month for the next 24 months. Let me go out and hedge my 2023 needs. So that's what he'll do. All right, I want to show you this. This is back in October of 2020. Okay, this is the diesel fuel price curve back in 2020. I think this is really interesting because in October of 2020, diesel fuel was way down here at $1.16. All right, we were $2.88 on the other chart. We're $1.16 in October of 2020. And remember, we had so much fuel put on the market that the fuel market was priced in a stair step up. That's called a carrying charge market, right? Just like you're used to seeing in the corn. It paid you to keep the fuel in storage, all right? And the reason it was kind of like that is because we still weren't flying jets all around the world. You got to remember, 40% of your air freight used to come, or 40% of the freight used to be in the bellies of a lot of those passenger jets even, coming back and forth across the oceans. So now you have to put it on ships. You know, the cargo planes are still flying, but you know what was in those passenger jet bellies where they make extra money hauling Amazon goods, that jet fuel had to be re-refined into diesel fuel. Okay, and then the refinery stopped making a lot of diesel fuel. They didn't stop, but they toned down how much they were actually making. 6 months later, this is March. 6 months later, in March of 2021, diesel fuel is now at $1.93. From $1.16 to $1.93 in 6 months. All right? Now look at the price curve. It went from that carrying charge market, now it's pretty flat. Really, if you look at this, it's slightly inverted, but that's $1.93. This is $1.90 right across here. And here's how it was priced going into 2022. You could have went in here and bought 2022 somewhere into this, $1.90 range back in March of 2021, and today it's at $2.88. So see, it pays to maybe learn also what you're doing in the grain market to hedge your crops. You may want to start looking at some of this in the diesel fuel. This is a days of supply of crude oil. Crude oil normally ran around this 90 to 100 day supply. This is including our SPR reserve, which has recently just been opened back up for companies to bid on to take fuel or crude oil out of. And as you can see when COVID hit, inventories and stocks just went through the roof. But then everybody shuts down, but because of the administration's pretty much telling people, don't loan money back to those Permian Basin drillers. Don't expand these refineries. We're going green. And then you got Volkswagen coming out and saying, we're not going to produce a internal combustion engine car by the end of 2030. Then you got a few other car makers saying the same thing. So now you just don't have the supply, right? So look at this. Now crude oil stocks in the United States are back at 80-day supply. Okay, it's very tight. You're back to where you were in 2004, 6, and 8. And in 2008 is when crude oil traded up to what? $140 a barrel. All right, here's a diesel fuel futures price chart. I'm starting to wind this up. Am I getting late? I'm fine. All right, 2020, we made this low near 60 cents a gallon. All right, diesel fuel comes back after the negative $40. This is when crude hits the negative $40. Diesel fuel is at 60. Comes on up in here. Here's the presidential election right here, November 2nd. Market starts to take on off. Boom. All right, because everybody understands in the world, in the trading world, what's going to happen to the petroleum industry, and the economy's starting to come back, even with masks and mandates and all this other stuff. Then December 2nd, the market makes another low right here. This is December 2nd of 2021, and in just the last 2 months for winter, diesel fuel's rallied 93 cents. 93 cents. All right, if you're using 7 gallons to the acre and you up 93 cents, what's 7 times 9? 63. So I just added $6.30 to the cost of diesel fuel. All right, hold on. Look at this. Diesel fuel price, it traded $2.93 2 days ago when I made this presentation. Off the 2020 low, up 488%. You don't need to trade Amazon. It's done better than Bitcoin in the last 2 years as well, I might add. All right. I also want to point out here that diesel fuel normally, though, has a strong historical seasonal tendency to peak out near and around February 24th. So if I go ask my computer software, hey, what's the best time to sell diesel fuel? When's it normally peak out the last 10 years? 9 out of the last 10 years, diesel fuel has peaked out right here, March 24th. So for example, in 2021, February 24th, if I'd have sold it at $1.90 a gallon by the March 18th, on that last day, I could have bought it back at a 178 and picked up 11.5 cents a gallon. $4,863 per contract profit. And if you look at this from a trading standpoint, in 2020, you could have sold it at 160.92. On March 18th, bought it back at 95.42, picked up another 65 cents. $27,000 a contract. Now, I don't look for that to happen this year because we're not in that kind of a bearish tone. But, if some of you are trying to wait and looking to get some diesel fuel price for spring, you may want to wait just another 2 weeks and see if this market hasn't topped out. Yesterday, possibly, could have been the top. And here's why I say that. Number one, I think you've had the last of your major winter weather. You had that polar vortex go down into Texas 2 days ago, right? And it did knock out 2 refineries. It knocked out Exxon's 650,000 barrel a day Mammoth refinery down there in Texas, and one other 220,000 barrel a day. I think they're a little more prepared for it. They're already starting to try and get them fired back up. And they probably had some extra parts that they've laid in because they knew they had so much trouble getting them last time, extra valves and switches. So we just had our last major snowstorm last week, right? And our cold weather, next 10-day forecast looks fairly mild right in here. If you look at the East Coast, they've had several major snowstorms and cold temperatures. They're going to have one more here for Valentine's Day. But you know what? When we used to trade a lot of home heating oil, which used to account for 30% of the diesel fuel market, we used to always say, hey, February 1st, there's only 28 days of winter left. That's what we always said. And we'd always look for a place to short the diesel fuel market. Now, the home heating oil market only accounts for 9% of the diesel fuel. The farming and agricultural only accounts for 6%. All right? And when I was back there talking about BP at Whiting, Indiana, that is always going to serve the North. Well, what's going to serve you? Well, there's a major refinery for Marathon down in Robinson, Illinois. 250, maybe 225,000 barrel a day refinery. It's a big old behemoth. You never hear anything about it though, right? It sits out there in the rural area. There's really not even a big town or build up around that refinery. There's a few little things, C-store, maybe a small little gas station in there, but it's been very quiet. You know what? If you're looking for an opportunity to keep securing your diesel fuel needs for years to come, because you don't want to be forced to buy, first you're going to be forced to buy the autonomous tractor, right? You can't get the labor. Oh man, my son doesn't want to come back to the farm, he's bored. You're looking, what are you going to do for the next 10 years? Even the bigger farmers are going to say, I can't get the labor. All right, but you go and invest in that. And then a couple of more years down the road, now you're getting taxed to buy the diesel fuel with carbon credits. Okay, you're going to be taxed. That's a carbon credit. You're dirtying up the pollution. All right, or you're polluting more. So now you're going to have to pay a carbon. Now you're going to have to convert that tractor to some sort of a battery, electric power thing, right? Well, right now a semi, currently with the technology there is, if you wanted to charge a semi up and get it back on the road within the hour, you would need enough power at that overpass where it's going to pull off that could power 4,000 homes in a small subdivision for 30 days. Well, how in the world can you go and convert semis then? Okay? Gasoline continues to go higher. It made a low in 2020 at 40 cents. It's now up to 260 something. And you got to remember, this is winter time for gasoline. Gasoline stocks normally have a tendency to build, which they are. In today's EIA report, I'm sure that came out at 9:30, gasoline stocks probably showed another build, but the market's not easing up. And it's what I'm being told from other gasoline trading desks and analysts. When we have to switch back to the summer RVP gas, stocks are going to end up getting tighter, and gasoline has potential to go substantially higher. Now, I don't expect any of you to understand any of this, but to me, this is a technical analysis picture of gasoline. It's called Elliott wave analysis. Elliott wave is kind of looking for the gasoline market futures market now to top out maybe just under this 275. Maybe we topped out yesterday. I don't know how the market's trading today, but we topped out maybe at 266. Could top out just under 75. Then we could see a very hard break back into summer, early summer, back into near $1.70. Now that's almost $1 a gallon. That's a move. Contracts 42,000 gallons. That would be, a dollar move would be almost $42,000 if you get that kind of break. But then you're looking at another run that could take you on up through the end of 2022 into early 23. And I'm just giving you this Elliott wave technical perspective that could take you up into $3.50 a gallon in the futures market. That'll equate to almost $4.50 a gallon or $4.30 a gallon in the cash retail market. Okay, here's an alternate count on crude oil that Elliott wave analysis put out 2 days ago. They're now giving consideration to hyperinflation. All right, so now they're saying that crude oil could surpass the $100 per barrel level, move on up into the 120. If you're at $120 crude oil and you're at about a $25 to $27 crack spread, that's $147 a barrel gasoline. You divide that by 42 and you're at $3.50 a gallon gasoline and diesel fuel. All the math kind of lines up. Skip that one. All right, guys, my last chart, which you're probably looking forward to. I just want to show you something. Here's a trucking firm. How many in here, have more than 20 trucks? Anybody? All right. You're looking at a trucking firm. Normally goes 2,000 miles a week. That's just average. A lot of them will even do more than that. The average semi is probably getting 6 miles per gallon. The semi is going to burn about 335 gallons of diesel fuel a week. Diesel fuel has gone up just 90 cents in just the last 2 months. Diesel fuel costs have increased by $300 per week on 52 weeks. That's $15,000 more in capital you need to run your trucking firm. All right? A lot of it, if you're hauling other than grain and you're hauling goods and services for another company, then you got to rely on what's called the diesel fuel surcharge. Well, you're not being able to keep up with how fast the futures market's going. Right now, you're losing money on your freight rates. And again, a farmer at 7 gallons to the acre, diesel fuel's gone up 90 cents in the last 2 months. Your diesel fuel is now costing you an extra $6.30 an acre in extra cost. And that's all I have to say. Thank you, everyone, and I appreciate your attention.
Well, that was chilling. Wow. I thought I left the chill outside, but when you look at the realities there, there's so many things explained there, Darren. I was in southwestern Indiana, where I have spent a lot of Decembers over more than 6 decades. I was crowded off the road by coal trucks. I didn't know what was going on. They were all over the road down there coming out of the mines. I mean, I think I saw 15 in a stretch of about 2 miles as they were responding to the market. Also down in that area, I'm wondering, is the Mount Vernon refinery still in operation down there, the co-op refinery? There's a small one. It's quite small. As a boy, we farmed a field where the pipeline ran from Mount Vernon up to, I think it's Rocheville, somewhere in the north central part of Indiana. I remember my dad telling me, I'm out there with a farmall and a 5-bottom plow. He said, you might want to watch that pipeline out there. Didn't scare me until about 30 years later, and I was visiting with a guy from one of the refineries, and he said, those are remarkably shallow in some spots. So I wondered about that. What a great view of the situation. And you'll have a chance, I know you've got a bunch of questions, you'll have a chance to ask some too in just a few minutes. Let's move on to talk about crop nutrients as Anita will come up and join us. Anita Lavelle currently serves as Director of Sales for Winfield United Crop Nutrients. After receiving her marketing degree from the University of Northern Iowa, she began her career at United Suppliers, now Winfield United. While with the company, she's held a variety of roles, including customer service, procurement, and sales over the last 18 years. She must have started when you were about 9, right, kid? She's been the National Director of Crop Nutrient Sales since 2011. Please welcome Anita Lavelle.
Alrighty, we're gonna get started on fertilizer here. Go to the next one. The first thing we're gonna talk about is just general market trends, right? This is not specific to this crop year that we're in or any other year that we've been in, but specific to fertilizer, part of what we've got to realize is 90% of what goes on in fertilizer, of how it's traded, happens outside the United States. We are that small in the landscape of crop nutrients, which is why you see some of the changes we've seen. It was not like this. I've been doing this enough years. It's not even like this 10 years ago. There's been that much dramatic change and will continue to change here in the fertilizer markets. This is a key piece as we move forward. When you look at this slide here, you've got different arrows. Those arrows represent trade flows, different colors or different products, and the bigger the arrow, the bigger the volume that moves that direction. Not meant to get huddled up in that piece, but the amount of different trade flows that we've seen over the past 20 years built, as you've seen recently from political changes, landscapes, these will change and change dramatically. And that's part of why we're seeing the changes we're seeing today. When we look at from a U.S. perspective, bring it more, I should say domestically, North American here, 87% of our domestic supply, North American supply, comes from these 6 companies. That's it. 5 are publicly traded, 1 would be privately held, 87% come from these 6. So when you look at it, 90% happens outside the United States, 87% of that 10% is from these 6 players, okay? Just to put on a little bit of a landscape, what we've seen 5 years ago, this would have at least probably been double this number, right? With mergers and acquisitions that have happened over the past 5 or 10 years that we've seen in a lot of commodity markets, but fertilizer would be no different. When you look at fertilizer, there are so many moving pieces. And when you look at this, the moving pieces have changed so much the past 2 years especially. There's more moving pieces to watch. Even in 0809, remember 0809? The big run-up of fertilizer, the big fall of fertilizer, right? That was not super fun from my perspective, at least. There are so many more different fundamentals to watch today than even 0809. That's how much this has changed in just those, short 10, 12 years. These are just a few of the things we look at. From a supply perspective, the biggest impact or biggest factor you would look at is your energy costs, or I should say your costs in general, right? That could be energy. That could be environmental cleanups if you're a phosphate manufacturer. This could be a lot of different things, but your cost is the biggest fundamental factor on the supply side of things. Then you go to the demand side of things. The demand side of the business is extremely hard to predict, and that's not an Illinois statement, that's not a US statement, that's a global statement. That's trying to predict India's demand, China's demand, the US demand, right? High level. That's what you're trying to predict. And you all can tell me better what goes into the demand picture for fertilizer, right? I'm guessing it's not just a grain price, right? It's quite a bit more dynamic than a grain price. But those are the 2 fundamentals continually pulling and pushing on each other. And fertilizer is no different than any typical commodity. It's economics, it's supply and demand, right? It's a constant pull back and forth to see where the price lands. This is what you get into. So on the left-hand side, you start in 2003. Okay, and you can see the 2008, 2009 movement, right? And then you get into today this is urea versus forward corn is what the slide shows. But you can just see the extreme volatility, and this is on the wholesale level, okay? Things are a little bit different when you go to the farm gate, but on a wholesale level, you do see some correlation to corn price. I'm gonna say some. This year, we've definitely not seen as much correlation. We'll go through why. But this is the kind of volatility that we've all kind of grown accustomed to, especially over the past 10, 12 years. Here's a great example of that volatility. And I won't try to belabor this, but this is extremely significant on a fertilizer basis. Number one, you've got to know urea is the global nitrogen. Globally, ammonia direct apply is not worth paying attention to, not big. UAN, not big on the global landscape. Urea is the nitrogen source that the world market moves on, okay? So that's why we pay so much attention to urea, even though obviously in central Illinois we're talking ammonia in UAN country. What we look at here, what you'll see is what we call a supply stack. And so what we look at as Winfield is we put all the supply pieces together and we're trying to predict the ceilings and the floors of the urea price in this example, okay? What you've got on the far left-hand side is your cheapest cost of production, okay? That's the guy that's got the cheapest cost. He's gonna run manufacturing probably until somebody says uncle, then he'll shut down, okay? That's North America, and that's been North America for quite some time because of our energy source, right, of nat gas. On the far right-hand side, this is where it gets kind of fascinating. You've seen a dramatic shift in the past 12 to 18 months. It has been coal in China for quite a while. This year, when you saw the energy source in Europe go crazy, right, the nat gas in Europe, that's where you see the right-hand chart in 21. You saw who flipped, and what's very dramatic, again, you go back to those trade flows. You have a very different source or area of the globe that's your highest cost supply, okay? And the problem is, globally, demand is saying, I need urea. What does that tell these manufacturers? Even though my cost is super, super high, they're willing to pay the price. They've got the demand, so they have to run. So if I'm anybody else except the high cost supplier, right, what do? That's market. So I'm gonna sell it for what the market is, not my cost, right? Typical commodities, right? We don't sell things at cost, you sell them at market, what the market is willing to bear for fertilizer or grain or automobiles, whatever it is, right? That's a dramatic shift you've seen in just 2021 to 22. And that dotted line, I don't know if you can see it, on the 21 side, it says 335 NOLA urea. Okay, that's what your cost, or I should say market would have been globally when you relate it back to a US perspective. In 22, that's 610. That's what global demand did to fertilizer as well as supply changes in 2022 versus 21. And we'll go through more of why. But it's very important to note from a high level perspective, this is what you're looking at. You had a significant change in what part of the globe was the highest cost supplier, and not only where it was, but just obviously the dramatic change of your energy costs. And that's reflected here. I do quite a few of events for our owners, and so one of the very common themes I hear of, okay, but I just need urea here in Iowa. I don't really care what China's doing. Well, we do. We very much care what China and India are doing. And when we look at the United States, and this goes for all of North America, there's three things. If I could barrel it all into three things, here's what I would tell you. One, it's a globally traded commodity. Go back to slide number one, 90% is traded outside of our borders, right? We're globally traded. We're a part of a much bigger system. Two, we are the third largest demand. We are not number one, we are not number two. And by three, we're talking a long distance number three in some commodities, not all, but in some of those commodities, we're talking a distant third. Okay, China and India, South America in some product lines, just depends. But we're not the highest level anymore. Third, we rely on imports. Now, this is the part that's going to get really interesting as we move forward when you see these governmental changes. The U.S. needs imports to have this supply, period, okay? That will change. When I say that, you're talking urea and phosphates primarily. A little bit of potash, a little bit of UAN, but that's what you're looking at. We have to have the imports. So when you look at the NOLA market, it's continually a signal to the globe of saying either the U.S. needs tons, and therefore we're higher priced, or the U.S. does not need tons, which means we're lower priced. Does that make sense? So we call it a bug light for my easy brain. Either you're turning the bug light on to say, boys, we need your product, or you turn it off and say, whoa, we got too much, take it somewhere else, okay? It's a constant change, and that's day by day, because as much as NOLA is changing, so is the global market. So India makes a move, then the U.S. makes it. That makes sense, right? You've got a continual change, and that's kind of the fun part of what we do. Before I move on, that's the high-level macro piece of this. This is the stuff that is stuff we watch every day, year in, year out, okay? Next, we're gonna go through, okay, things are different, right? Things are different in 22 than what they were in 21. They're also different than 08, 09. Very different fundamental markets we're talking about today versus previous years. A little bit, kind of similar. We're gonna take a little bit of a step back and kind of bring you back up to speed of where things are at. In mid-2020, the impact of COVID to fertilizer was a couple things. First and foremost, it put off turnarounds, okay? So what happens is a lot of the manufacturing plants, right, they bring a plant down, make their, maintenance, repairs, whatever the case may be, and they bring it back up. It's very scheduled, it's very routine. The market, S&D, the way everybody's tracking it is built, knowing, okay, these plants are gonna go down for 10 days. That's about 10,000 tons of ammonia per day. Here's what that equates to. COVID hits, and if you're running a manufacturing facility, you're not letting other people onto your site, right? You can't contain it. So what happens is you put off turnarounds. What does that cause? One, you have more reliability issues, right? You could have bigger issues with maintenance. And two, eventually you have to maintain the plant, right? With the amount of money at risk, eventually you have to maintain that plant. That's one piece of it. When you look at, you got high grain prices, and we'll go through a few of these in further detail as well. You've got higher costs, which we've all kind of experienced. And again, I want to go to that bottom one, is these political changes are getting quite large from a fertilizer perspective. And not just the US, I'm talking globally. The continual political changes or uneasiness in the marketplace will continue to affect fertilizer until we see some things slow down. Obviously, you fast forward to 2020 to 2022, you've got a commodity price boom. Again, this is not just fertilizer, right? This is everything we're touching, but fertilizer is no different. When you look at your commodities, what is fertilizer, right? It's a commodity by nature, right? So we saw the exact same cycle in commodities in fertilizer that we saw in the raw nature of commodities. When you look at this, you look at high crop prices, and again, these are global factors. These are not just US or Midwest. When you look at from a global perspective, you've had increased demand. You saw 2018-19 where you did see a reduction, but in 2021, you saw high demand. And again, that's not just here. We're talking everywhere around the globe. You're seeing high demand for fertilizer, whether that's acre growth, whether that's application growth, whatever the case may be, you saw very good demand. And I'm going to say, when you look at urea and nitrogens in particular, India was huge demand for urea the past 12, 18 months. Very, very large, significantly more than normal. On the other side of that, you've got these high global energy costs, right, which we've already kind of talked about. I try not to belabor this. But this is the kind of a steep curve you're talking about when you look at energy prices. We had our customer meeting in September of last year. And at that point, energy costs in Europe were 16 per MMBTU, okay? Before this was done, they were up to 65. And at 15, we're talking prices kind of where we're at today, quite truthfully. So we never saw it sounds crazy to think about with where fertilizer's priced today. We did not ever see the true high of fertilizer, of what it could have been, if the market would have reflected true energy costs in Europe. That's the crazy part. Today, that's settling out about 25 to 30. Again, we're talking historically, that's 5 to 7, not 25. We're talking 5 times more than what we would consider quote unquote historical, normal, whatever you want to call it. And that doesn't look any different for summer. Take it a step further and we'll go through this. But it doesn't look a lot different when you get into the forward months. That's what we're seeing in fertilizer. On top of this, I'm going to go back. We saw shutdowns in the US and North America, but primarily in the US. 2 reasons. We had the winter storm last February. From a fertilizer perspective, much like refineries, right? You don't just shut these babies down, right? That you have pipes that are frozen. They actually sent some pictures around. These are plants not built to be in Texas, or not meant to have Iowa weather in Texas, right? We didn't see those issues in Iowa, Western Canada. We didn't see those issues. Why? Because they're used to it. Like, yeah, that kind of sucks, but we're used to this. So they didn't see those issues up north. The problem is, much like refineries, you're seeing major production affected. You're seeing Woodward, Oklahoma, which is 7,000 tons of UAN every day coming out of that plant. Okay, That, you got Borger, Texas, you've got Enid, Oklahoma, you've got some major production plants that saw the exact same situation that the refinery saw. We did have the hurricane that shut off phosphates, that took about 500,000 tons out of the phosphate market as well. And then again, you go back in COVID era, you didn't have shutdowns. Well, what happens when it's less of a COVID era, however you want to phrase that, and when it's less of an issue, what does everybody do? Take their plants down, right? It's turnaround. We missed last year, so we got to turn it down. We got to turn this in to a maintenance period now. Okay, so the last slide was higher than expected demand. Now we're seeing less than expected supply. What do we get? Really high fertilizer, right? These are the main factors that led to the situation we're in. And then my favorite slide. So the political landscape, these are primarily US pieces. You've got China in the middle of this. I would also, when you look at all these, each one by itself is pretty significant. And when you start combining 5, and these are just the ones that made major publications that are more new, this gets pretty significant. You're altering trade flows from a global perspective, not just the US. This is a global trade change that we're still figuring out as an industry of where are my phosphates going to come from? Because where they used to come from, they now have a 20 to 40% duty on top that they're not willing to pay. So now where do I get my phosphates? Same situation on UAN. Where there have been imports, 2 million tons a year coming in, that's remaining to be seen how that will parlay into the market. Even before this, I would add India being a very significant player on the demand side of things. They also have a subsidy system in India. If you're not familiar with it, kind of take a look at that as well. It's very different, but it can relate. It can forecast or lead into very different demand pictures based on their subsidy payments in their local market. So that can very much change the trade flows as well and their demand as well. One other thing I want to add in here is the logistics piece. Logistics, we kind of went through it a little bit, and we look at it more from just even the drivers of people actually driving the trucks is getting quite difficult. We run a trucking fleet, I'm sure many in this room do, and just finding the people to run the trucks is becoming quite an issue. And on top of that, you look at a fertilizer shed, say holds 20,000 tons of fertilizer, it's like 850 trucks, right? You don't fill that in a week, right? There's pre-planning that goes into this thing, even before the trucking issues we've seen over the past 18 months. So you compound all of these issues, and then you make it into a logistics concern of how long can I wait if I don't like the price before, logistically, I have to have this. I have to have this to go for spring season for my owners. And that's been a concern and will continue to be a concern as we move forward here as well. We'll get into product outlooks here. And I apologize, those are not really big fonts right there. From the bullish side of things, so I verbally might go a little bit deeper just because we have had some changes since these were drafted up. Right now, you've got India tendering for urea, right? If you've seen that in the publications. And when they come out for a tender, basically what they say is, as a government, we come out and say we want to buy urea on behalf of our grower system, to make it in my terms. And what you've seen is them come in earlier than expected. That's a bullish factor, right? You had increased demand come in sooner into the market. So that's a bullish picture. What we've seen on the supply side then come out and say is, well, here's 3 million tons of urea for you. That's a bearish picture, right? That's more urea than what would be expected on a traditional tender. And so now what you're diving through is what are the price points, and also where's the product coming from. On the bottom side, you've got China as an export with a question mark. There's major questions around China on both urea and phosphates of what their export lineup looks like. They have publicly basically said, especially on phosphates, it's been pretty well known, we're not exporting from a China perspective. That's an issue. We'll get into that. From a urea perspective, we're exporting very, very tiny amounts. It's very almost kind of government to government deals. It's not traditional large volume. There is, in the marketplace, there's some conjecture or speculation if that changes after the Olympics and they ramp production back up. That is pure speculation. We'll have to wait and see kind of how that plays out yet. But the positive side or the bullish side of this thing, you've got India stepping in for demand, and you've got this high European natural gas continuing. And you look at the forward trends, it doesn't look to get much better as you go into the summer months. On the other side of things, from a more U.S. perspective here, we have imported quite a bit of urea, more than last year at this point. So while we need more import tons yet to get through spring season, it's not a dramatic volume that's required that we believe we can call on pretty quickly. The interesting thing on urea, and it more goes into UAN and ammonia, is these price spreads. If I'm a grower looking at my nitrogen options of ammonia, UAN, and urea, our perception would be UAN and ammonia are going to feel pretty expensive on a per unit basis comparatively to urea. In other words, the spread our opinion would be it's going to be wider than normal and not just by a couple cents per unit, probably quite a bit more on the spread basis. The reason that matters to urea is there a demand shift to urea, right? Again, you go back to the demand side of things, trying to predict is that demand shift over to urea that was an ammonia ton or a UAN ton, okay? Those are the that could be a watch out, in other words. We'll dive into UAN a little bit here. This has been a very much changing dynamic here over the past, month here, where you've got new tariffs and duties, however you want to phrase it, on the U.S. on import tons into the United States. Of the tons imported to the United States, 95% of those tons would be considered duty tons, okay? And we're talking anywhere from 2% to 65%. Preliminary. That's not done. That would not be finalized until, I believe, June or July of this year. But at this point, if you're an importer, you're not taking the risk to bring those tons over here. To take that into a context, if we had to import UAN into the United States, it would be $100 to $120 per ton higher than what it is today to get those tons because of those duties, primarily. Okay, so you really can't call on those tons. Physically, you don't need the tons here in the U.S. Logistically might be different, but generically speaking, you've got enough UAN in the U.S. to serve the U.S. market. But if you would need to call on the ton, it's significantly higher priced if we have to go on the open market, go globally to import tons. So this is where UAN gets really interesting this spring season. Again, you go back to that basis or the spread between nitrogens. That's the big question. When you look at that first bullet point on the bears, relatively cheap urea, we use the word relatively, it's still super expensive, but when you look at UAN and you'll see the same on ammonia, you're gonna see a pretty big spread comparatively to normal from our perspective. The other thing on UAN that we'll have to continue to watch is this fall ammonia run. And when I say that, fall ammonia run happens upper Midwest, call it the I-states, Kansas, et cetera, right? Western Canada as well. When you look at that, the fall ammonia run was very large for most markets. It was not a pocket that saw this huge ammonia run. It was a big enough span of geography. We've not seen this before as an industry. Number one, it's surprising we didn't run out. We're still kind of trying to piece that together a little bit. How did we not run out? Or go and allocate all those things that have supply issues. But when you put that many ammonia pounds on the ground, obviously you would assume there's a shift coming. You're just trying to predict where, what state, what form of nitrogen did that take away from, or was it just new acres, right? Those are the things that are playing in the dynamics here as we move forward. On ammonia, from an ammonia perspective, because of the large fall run, obviously the system is pretty empty, right? So from a manufacturer perspective, there's not a big sense of urgency because they drained the system pretty darn well last fall season. Again, across most of across most of North America, quite truthfully. You still have a high global energy market. I would also call out in Europe, where it is the high cost supplier right now, that is primarily an ammonia market. It's not ammonia supply. That's where a lot of global ammonia supply would come from. So if the global market loses ammonia specifically, that would be a key area where it would have been lost. When you look at the concerns or the bearish points of this thing, spring, again, you look at the spreads and you look at what urea versus ammonia, it would tell you you would switch to urea. I would tell you in 9 out of the 10 markets I work in across North America, that switch does not happen. It does not matter the spread. Ammonia guys put on ammonia and UAN guys put on UAN, and that doesn't change. So I could be very easily proven wrong this spring if a majority of the market switches to urea. The market wouldn't be prepared for that, but that is a question mark. But everybody that's been doing this even longer than me would say, you're not getting ammonia guys to switch away from ammonia. It's just not happening. So wait to be seen how that turns out, but it will be lighter spring ammonia, even if it was just ammonia acres from the fall season. We would anticipate that to be pretty consistent. At the end, I will go through more of a forward outlook as well, a couple bullet points. I'm going to shift over to phosphates. Phosphates are very different, obviously, from a mining perspective. When you look at phosphates, there's a limited finite resource that you're working through versus nitrogens. You just get more natural gas or coal or whatever, and you just keep producing. Phosphates and potash obviously be very different. From a phosphate global perspective, you've had this NOLA bounce around quite a bit, trying to figure out how we work in these new era of tariffs. We've had tariffs in phosphates for probably a year, almost a year, not quite, almost a year. So the market's still kind of figuring out how to operate without significant imports into the US market. Not only that, but India's demand has been bigger and China's supply has been less, okay? So there is not one certain thing on any of these products you can say, well, here's why fertilizer is so high priced. It's a culmination of about 5 chess pieces that all moved at once in that same direction. Same happened on phosphates. On the bearish side of things, we are seeing imports more on the DAP and triple side of things, not as much MAP. So knowing Illinois is kind of traditionally a MAP market, and DAP as well, we're not seeing the MAP imports like we are DAP. That's a variety of reasons, but that would be a difference than normal. When you look at the spring demand, again, you go back to fall, it was a heck of a fall season for P&K as well as ammonia. So there's obviously a question of how much demand is left to go for spring phosphates. So that'll be the watch out as we head into spring season, what is left to go from a phosphate perspective. When you look on a global landscape, traditionally I would tell you we see phosphates are the first cut. If I've got X amount of dollars to spend, phosphates can be the first place cut, which is where we're a little just more watchful of that one. But I would also tell you on the supply side of any fertilizer, and I'm going to say globally, this is not just a US comment or North American comment, phosphates are much more fundamentally supported by a lack of supply in the marketplace and bigger demand, okay? So that is it's different than nitrogens from that perspective, okay? So and again, that's a global statement, not necessarily always US statement. Last but not least, potash. So we've got these Belaruski sanctions. We've still got questions between Russia and Ukraine of what's going to happen with those types of situations. Obviously, Russia is very much a big potash supply source globally, along with Canada. But that's going to be a big question mark heading into the rest of this calendar year. Spring's kind of set, but when we look into summer fill or more Q3, that's going to be the major question mark, how that situation resolves itself. We do have production ramping up in Western Canada. Again, there are some logistical things. We won't have supply issues, but I don't see major changes on the potash side of things until we're past application and we look at resetting for the next crop year. So to kind of wrap up from a product looking forward perspective, here's where, and we would boil it down to, from a spring nitrogen perspective, and I've kind of commented on this, I would expect this volatility in urea to continue, okay? And the reason I say that, we've seen urea trade up and down $100 per ton in a day, easily. We've not seen that since 08-09. Totally different reasons, so don't let your head go there. Totally different fundamental reasons why, but you're seeing that much volatility in a day. Okay, we calculated it one day in a week. I think we had over $270 per ton change. Okay, that's on the wholesale side. That's the kind of significant changes we're talking. I would expect that to continue because every time India comes in for a tender, right now they're issuing counteroffers. So basically what they open their bids and they say, oh, I got all these tons, but I don't like the price. So I'm going to send them back over the fence and say, try again. So now, and what happens is every time this happens, the market moves, okay? Everybody's trying to react to every different move that everybody's playing here. I would expect that to continue. I would also expect UAN and ammonia to hold a pretty hefty premium to urea on a per unit basis. Logistics on ammonia will continue to be difficult. Again, that's a North American statement, not any place in particular, but I would expect UAN and ammonia to hold that premium. I would also expect, exception of Kansas, markets demand's pretty well set in the nitrogen source they choose, typically. From a spring P&K perspective, don't expect a lot of changes from a pricing perspective. Right now, it's a logistics game to make sure the tons are in place when you need them, the day you need them. That's the name of the game today for P&K. Any significant price changes on P&K, I would expect in Q3 as you plan for next crop year. The caveat I would call out is if grower demand is just big on phosphates in particular, that could be a watch out where you could see additional price increases just because it's not, especially on MAP, because it's not here. It's not logistically ready to go. That would be the call, is if the demand outpaces expectations. The next crop here, because that's where I kind of get my stomach in knots, is really the next crop here, because really this crop here is kind of well baked, high level from a global and North American perspective. Looking at next crop here is, okay, first is what are carryout inventories. So when we put a stake in this thing and say, we're done, crop year's done, what's the carryout inventory, both at the retail level, at the wholesale level, at the manufacturer level? What is that global picture for supply, right? On top of that, you've got these energy costs that it's hard to take a bunch of risk for any of us in the supply chain with these kind of risks associated with them. Again, I'm talking more, this is totally next crop year that we're looking at for Q3, starting August, September, October kind of timeframes. So that's what we would see looking ahead.
Wow, what a great view, Anita. It's a little bit sobering too, isn't it? There's going to be a quiz, by the way, after we're done here. I'll be passing around the pop quiz. You're getting a lot of information in a short period of time, but you'll have a chance to follow up with some questions too, to really zero in on what matters to you individually. Now we get to the fun part, hopefully, right? As we're going to visit with Brian Schubeiler, we're going to invite Brian up here to talk a bit about the grain market situation, and he has a lot of expertise in that particular area. Brian is Senior Vice President of Trading and Risk Management for CHS Global Grain and Processing. He is responsible for all the CHS Global Commodity Trading, the global market expansion, the product line and risk management, including freight, currency, execution, and trade finance. Brian has spent his career, as a matter of fact, with the Cooperative, joining CHS as an intern. And his experience includes working in 3 business units and several special assignments. Brian grew up on a farm in western Minnesota, a crop and turkey farm there. He earned a bachelor's degree in agricultural business from the University of Minnesota. He represents CHS on the board of directors for Temco, a grain marketing joint venture with Cargill. And he holds a seat on the board of directors of the National Grain and Feed Association. Please welcome, if you would, to take a look at this market situation for grains, Brian Schubeiler.
Good morning, everybody. Excuse me. So Tim, I know now, I looked on the agenda and I saw the grain guy was going last, which we're used to that, being last. But now I understand why. I mean, Anita and Darren, what lousy news. I, on the other hand, nothing but smooth sailing, good grain prices for the next coming years. So, no, I'm just kidding. Not about the grain prices. So I want to thank Tim for inviting me to come and talk a little bit about the grain markets. I'm not going to get into the weeds. Plenty of people can do that and do that. I'm just going to talk about the more macro events that will impact grain and grain prices throughout this coming year and probably years into the future. So So another full disclosure here, we have our marketing and communications team help us put our presentations together because we have to have the fonts right, we have to have everything just right. And the particular lady that helps the Global Grain and Processing Group put stuff together is an Iowa girl, Iowa farm girl. No, that was good. She really liked this picture. And she goes, you gotta have this in the presentation. I said, but I really don't know what to say about it, other than it's a nice looking planter. But so I'm gonna take this opportunity and say thank you for all of you and the profession you're in and what you do to feed the world. It's truly remarkable. And we get a bad rap a lot of times. And I think Darren brought it up more than once in his talk about how, sustainability and carbon and all that stuff is the topic of the day, and how farmers get a little bit of a bad rap in the way they go about it and aren't good stewards of the land. And I think it's unfortunate that people don't understand what we do in our sector, and how appreciative they should be for having inexpensive food, quite honestly. So thank you all again for what you do. I want to take just a moment. CHS isn't big in this neck of the woods. Excuse me. But I want to just kind of go through what our footprint is. And so these are the global grain and processing highlights. We really have a grain business and we have a processing business. And you can see on the very left-hand side that we handle about 2.7 billion bushels a year. We sell it to 70 different countries, and we operate out of 4 main regions. And those regions are South America, which includes Brazil, Argentina, and Paraguay and Uruguay. And we handle about 200 million bushels. It's primarily an export-driven business. Our goal for being there, our goal for all of our international business is to do business with those customers that are primarily US-based customers. Customers nowadays want 24-hour, 7-day-a-week, 365-day-a-year competitive markets from their suppliers. And if we were only to be able to offer from the US, we, as you'll see in the future slides, we would be giving a lot of the market up to other competitors. We also operate out of EMEA, so that's really Ukraine, Russia, Romania, Bulgaria, Serbia, what we consider the Danube. Excuse me. The Danube region. Don't know what's going on there. The Danube region, and we handle primarily corn and wheat out of those areas. And then we also operate out of the Asia-Pacific region. That's China, Taiwan, South Korea, Japan, and then Southeast Asian countries. So, Vietnam, Malaysia, not Singapore, but Indonesia. Again, so we are a very global company. But then we also do a lot of processing in the United States. We have 2 soybean crushing plants where we crush about 125 million bushels of soybeans a year, producing about 2.7 million tons of soybean meal, and then produce 2 billion pounds of oil. And the oil part is getting more and more interesting as we go, and I'll talk about that a little bit more. But then we also crush canola up in northern Minnesota with one plant. But then we also make ethanol, and then we market ethanol for several independent ethanol plants. So all in all, that's the global grain and processing footprint. So for the remainder of our time together, and if I can't get this voice back, it might be a little shorter than you think. But these are the things I want to talk about. Again, global disruptors. What are those things that are happening around the globe right now that will have an impact on the grain markets? Renewable fuels. specifically, they're coming back in vogue. They were there for a while, they left for a while, now they're coming back in vogue, given this administration's current policies. Global trade, something that's very important for U.S. agriculture, because a good portion of what we grow goes to an overseas market. And then I'll finish up with technology and labor. And that really doesn't have an impact on grain prices, but it has an impact on all of us going forward here as far as how we run our businesses. So the first disruptor that I'll talk about is geopolitical events that may or may not happen. And I'll get to the Russia-Ukraine thing in a minute. But the other big one that has not been talked about much yet is China-Taiwan. And if that one happens, that will be much bigger than this event here. But what China wants is for Taiwan to be reunified with the mother country. And they want a one China policy. Taiwan has obviously leaned more towards democracy. The United States has openly supported that. China doesn't like that. My guess is as soon as the Olympics are over on the 20th of February, we'll start to see more talk about what's going on there. Apologize. So at hand right now, the one that's getting the most press and is immediate, it's happening as we speak, is the Russia-Ukraine situation. You can see that Russia has a very large border with Ukraine. What makes it even more is that Belarus is a Russian sympathetic country. And then in 2014, Russia annexed Crimea. So Ukraine, if you look at the country, is surrounded by Russia here, basically. And what Putin says he doesn't want is for a continued expansion of NATO. In other words, he does not want Ukraine to become part of NATO. And we don't know if that's his only reason or if he just sees how all of this plays out. If Ukraine does become one of the NATO countries, how now you have a NATO country here to here down to here, but it gets really right on his doorstep. And that's disconcerting for him. So that's really the crux of it. I think the Nord Stream 2 pipeline has a little bit to play into this as well, since it's been, the Europeans have stopped production on it, but I really think it's really more about this. Because if he doesn't do it now, and Ukraine gets into NATO, it's done, right? They'll be part of NATO, other countries will be forced to defend them as if they were being attacked themselves. So it's a big deal for Putin. The states here or the countries here on the left with the numbers are those countries that have already entered into NATO post-1997. And you can see all the other NATO countries in the deeper blue that were joined in before 1997. So we have employees over there working out of Kiev and other locations in Ukraine. And 3 weeks ago, they were kind of laughing at the rhetoric that the Biden administration was putting out there and how this wasn't going to be real. There's no way they're going to attack. But then during the Olympics, at the opening ceremonies, if everybody remembers, Putin and Xi Jinping kind of came out with a joint statement, one supporting the other's position, whether it be NATO or whether it be the one China policy. That really changed people's minds in Ukraine. And there's been a lot of training. A lot of our employees would be drafted into the army over there if there's an invasion. So it's becoming a much bigger deal. A lot of companies, international companies in particular, have stopped doing business there, just in the event that something would happen. But if they were to invade, probably the biggest thing right now is markets would shoot up, flat prices. corn and wheat supply chains would be disrupted in a big way because Russia's the world's largest exporter of wheat. Ukraine's number 4, but Ukraine also exports a lot of corn. So the market would have to rebalance itself, and so there'd be a lot of volatility. Probably actually good for the United States and South America. The second, what I'll call disruptor or event that is taking place right now is the drought situation going on in South America. You can see the map of Brazil. This is the part of the country that is harvesting soybeans right now. And you can see they're wet, extremely wet. And then you go south of Brazil, in Brazil, which this area here sits on top of here. So you can see there's a very large area that is extremely dry. They've gotten some moisture in the last couple weeks, but still forecast temperatures are very abnormally high and not conducive to good grain growing weather. Brazil's crop in the very beginning was expected to be about 146 million tons. They've dropped that down to about 128 right now. And there's probably there's a report coming out in about 6 minutes that'll make everything I say wrong. But the USDA still has them, I believe, at 139, somewhere in there. So we're expecting today's report to bring that down. But to put it in bushel terms for you, they're going to produce about 700, between Brazil, Paraguay, and Argentina, will produce about 750 million less bushels of soybeans than what the market is expecting them. That's what CHS believes. If you think about that, you can do some tweaking, but you have about 500 million bushels then less exports out of Brazil and Argentina. If you think about where the U.S. sits right now, we have a fairly tight carryout ourselves, about 340 million bushels. So the math doesn't add up. The market will make it work, but what's going to happen in the meantime? That is very supportive prices. Then when you flip over to the U.S., and this was a drought monitor map from about a week ago, and you can see that we're starting out, particularly in the wheat-growing country, very dry. And over here, we're dry. You guys are in God's country. But a situation weather-wise could develop in the United States as well. We've seen some very extreme and volatile weather here in the last couple of years. This could play out too. That is going to continue to make for supportive pricing as well. Until we know, which wouldn't be till June or July, you're going to have a risk premium put into the markets. And then the third disruptor that I'll talk about is inflation. Darren mentioned it. Anita alluded to it from fertilizer prices, but just about everything you do is more expensive. If you follow the blue line and go back 12 years, inflation has been around that 2 to 2.5%, which is the Fed's target rate. Okay? Then we get into the pandemic, and we pump about $5 to $6 trillion into the economy, and this starts to happen as we open up the economy again. So a combination of easy money policy, supply chain disruptions, and a labor market that's really crazy right now, you're getting inflation. Everything is more expensive. Not to mention, back in January of 2020, the Fed's balance sheet was about $4 trillion. Now it's about $9 trillion. So what's going to happen here is the Fed has decided that it's no longer a transient, meaning temporary situation, that this is more of a permanent situation, and they're going to act. And most people believe, or most economists believe, that they'll raise interest rates as many as 5 times this year, starting in March. So, the inflation has helped commodity prices. That's been a good thing for us. But now the fun is over, and they're going to start to raise interest rates. They're going to start to taper off some of these bond holdings that they have, so the balance sheet goes back down. All of those things are going to make it more expensive again for us to do business because we have capital-intensive businesses. So this isn't something that's going to dramatically change prices in the near term, but as you think about how U.S. competes around the world, this will make it for a stronger dollar and more expensive for us to produce, which is going to be to the advantage of, our friends in the EMEA region and South America. That's the only negative thing I got, I think, today. So I'm going to pick up where Darren left off on energy and talk about renewable fuels. And again, the sustainability and carbon reduction mantra that is out there right now really is breathing new life into the renewable fuel space, whether that's biodiesel, sustainable aviation fuels that you make from, or potentially they're going to be making from ethanol, or renewable diesel, which seems to be the new darling here at the moment. So this is a little bit complicated map, but what it shows is the states that either have passed or are considering to pass an LCFS. And an LCFS is a low carbon fuel standard, is what it stands for. And so, in particular, California passed it in 2009. So they're well into executing their plan. And what it is legislation that the state wants to lower their carbon footprint. And they're doing it through transportation fuels. And so, if you're a refiner in California, or you're a refiner that ships your diesel fuel to California, you are obligated to put lower carbon footprinted fuel into that state. If you don't do that, you have to buy credits. Credits are expensive, so most people now are starting to consider, how do I do that and still run my refinery in California? The answer is we're converting plants to renewable diesel plants. And I'll get into more of that in just a second. But how this works is you can see here that crude oil has a carbon intensity score of 100. If you look at soybeans, which they call soybeans generation 1, what that really means is if you have open pasture ground and you break that ground up, releasing carbon into the air and plant soybeans, you're going to only get a carbon score of 80. If you're doing traditional soybean planting on a row crop rotation, then you're going to get more like a 55 type of score. You can see here that every potential feedstock has a different carbon score. The carbon score matters because that's how much of a subsidy you get for producing that lower carbon diesel. The problem is the lowest carbon is animal fat, tallow, used cooking oil. So your restaurant throws out their oil, that's used cooking oil. That's one source of it. That has the best footprint, but the inelasticity of it is pretty incredible, right? I mean, there's only so much of that to go around. And then you have canola and corn oil. So by far, soybean oil is going to be the feedstock of choice as you think about renewable diesel going forward. And this is just kind of a fun little pie chart, just to show you the potential if the rest of the world follows what the United States is looking at doing. Global diesel demand around the world is 422 billion gallons. If you take all of today's vegetable oil production, including palm oil, which is not a renewable fuel feedstock, you have 62 billion gallons total. So you have significant opportunity here from a vegetable oil standpoint to make for renewable diesel. And I'm going to go back just 1 second here. So what I'm going to talk about going forward is through 2026, so not very far from now. And it's really going to be based on California, Oregon, and Washington State. They've passed their LCFS already. These are other states that are looking to pass LCFSs, okay? So anything that is a potential or proposed is not included in the numbers that I'm going to be talking about. They just add to the numbers. Can everybody hear me? Okay. So they'll just add to those numbers. So what has been passed so far and what refiners, traditional refiners, and greenfield renewable diesel plant sites have proposed equates to about 1.1 billion gallons of renewable diesel demand. What that means to a vegetable oil crusher like ourselves, when you think about it, is it's an additional 8 billion pounds of new demand for vegetable oil, soybean oil. And again, take that into consider, just throwing some numbers out here, that's 14 additional crushing plants that don't exist today. That's an additional 680 million bushels of beans. This is just California, Oregon, and Washington State. So when you think about it, crush margins have been phenomenal. In my entire career, I've not seen anything like it is right now. And what's really amazing is soybean oil is 20% of the product derived from a soybean, and it's now 50% of the margin. So oil is definitely driving the bus because of this renewable diesel piece. This chart here on the left, you can see that current crush capacity is about 2.5 billion. What we see in the green in 25, 26 is about a 2.8 billion that has been either started construction or proposed. We need an additional, we need to get to 3.2 billion crush capacity in the United States to get to where we need to be in 2025, 26 from a renewable diesel perspective. So a lot of numbers. Bottom line is we've got a lot of work to do here to figure out how to balance the demand for renewable diesel and how to supply it. So I mentioned 680 million additional bushels that are going to be needed. That's 13 million more acres of beans at current average yields. Or we export 2 billion bushels of beans. We could not do any, or we could do some. That's another opportunity. We also feed about 15 billion pounds of oil in your vegetable oil and in commercial restaurants and things like that. We could drop that down. So there's a lot of combinations that will play out over time. I will tell you though that because of subsidies and stuff, renewable diesel, they pay up. It's good business when they need to keep their plant running. So this food versus fuel story is going to start to become more prevalent as we go along. But now the other issue is when we make this much more soybean oil, we're also going to make 15 million more tons of soybean meal. And so going forward, we can handle about 4 million tons of that meal in the United States because there's a natural growth, about 2% a year from a livestock perspective. But the balance of that is going to have to be shipped overseas. And so we'll see protein, we think, very cheap in the coming years because we're going to have to clear the market. We're going to have to export and compete with people that export to those places today. We'll be going primarily to Southeast Asia. That competes with Argentina. We'll be going into Europe. That competes with Brazil. So we think protein prices will get fairly cheap in the coming years. Good for livestock producers. So I'm going to change over to global trade. And again, I mentioned in my opening that global trade has always been very important to the United States. And if you think about 17% on any given year of the corn we produce goes overseas. About 50% of the soybeans and about 50% of our wheat goes overseas as well. So it's very important that the United States maintains an export presence as we go forward. When we think about demand, we got to think about China. China imports 58% of all the world's soybeans. 58%. That's like 3.6 billion bushels they import. And they grow some of their own as well. But on the feed grains perspective, things have changed a bit. We've anticipated China coming in and buying corn from the US for many years now. And they just never have until we got into the phase one deal, which I'll touch on in a second. But since that time now, if you look at this chart, you can see the different feed grains. These are all the feed grains that make up nutrition-based rations in China. You can see that in 2013, 14, 15, 16, production was keeping up with usage. So no need to go outside of China and import, right? And China's a very proud country, and they would love to be self-sufficient in everything that they feed and not import anything. And so they held off for quite a while. And you could start to see they were going into their reserves and into inventories as they go forward. Up until 2020, 2021, they had to start importing. They were just running out of reserves to continue to put feed pigs and poultry and aquaculture. And so it's interesting how the dynamics and timing of the phase one deal and China's need to import feed grains worked out. So the phase one deal was a 2-year deal, and it was from 2020 and 2021 crop years. Ended in December of 2021. China was supposed to buy about $90 billion of ag commodity products. They bought about $72 billion worth, about 90%. We, as a grain company, consider that to be a success. Had they came in and bought a bunch more, quite honestly, I don't know that we could have handled that from an exporting capability perspective. So we want to continue to see and get China demand, but we feel very satisfied that on that small portion of the phase one deal, China and the US were very successful working together. But as we go forward, you can see that we expect soybean imports to level off at give or take about 100 million tons a year. We expect about 21 to 24 million tons of corn to be imported, and then about 9 to 10 million tons of wheat, just to maintain a balance between production and usage inside China. The reason all this is happening is not because China's not producing as much food. They are. It's just their middle class, and they have 1.3 billion people. Their middle class is becoming much more affluent, and they want protein. And so demand for pork, demand for fish, demand for even poultry now has gone up significantly, and that takes protein to feed the animals. In the past, China had their biggest hog farms was an average of eight pigs per farm. And since the swine flu in 2018, China has rethought how they're going to do commercial hog production. And I'm not 100% on these numbers, but I read an article where they're building hog hotels. Has anybody heard about this? So they're building 34 hog hotels that'll produce, I think, 16 million pigs. And they're 14 floors. The pig starts on one end of the floor and goes to the other end and never leaves that floor until it's going to market. And that's how they maintain good hygiene and keep disease away. But there's 14 different farms. I think there's like 30,000 on each floor, something like that. It's incredible. If you're interested, Google YouTube and say Hog Hotel, and it's a really fascinating video. But that's why, right? I mean, it's pure demand. So that demand is continuing to grow. So moving on to the export side of the business. So Brazil, Argentina, and the Black Sea region are our biggest competitors. This chart, if you look on the left, so the green is the United States, the darker blue is Brazil, lighter blue Argentina, and the light gray is the Black Sea, and then the rest of the world. If you start over on the left, you can see that the United States back in 2005, 2006 enjoyed about a 67% market share of corn exports. Fast forward to 21, 22, we're at 30. So we're expecting to export about 2.5 billion bushels this year. That's about 30% of the total export market. But you can see that Brazil went from 6 to 21%. Argentina grew a little bit, but Black Sea went from 3 to 19%. And the most alarming part of all this is every acre that they put into production and every acre that they're producing now is yielding more and more and more corn. They've doubled. Brazil is like up 200% from 2010 till now in terms of production. Brazil's building a local domestic market for their corn, but still their production is outpacing their own internal demand. Everything Black Sea produces is exported. Beyond anything they would produce next year that they didn't produce this year will be exported. In Black Sea, excuse me, in Black Sea in particular, quality and shipment to ports has gotten much better. So much more of their product actually is getting to market. And so we expect over time we'll continue to lose market share to those two countries. And that's why it's important for us to, although we have good prices today, we just got to make sure that we're watching how efficiently we are at producing, using technology to produce more crops at an efficient price. When you look at soybeans, it's really a U.S. Brazil story. But you can see again, back in 2005, both the U.S. and Brazil had about a 40% market share. And now Brazil enjoys a 56% market share, and we're down to 33%. I promise I don't have COVID. But you can see too that Argentina, thanks. You can see that Argentina is really not in the picture from a soybean export perspective anymore. Everything they produce gets crushed and they sell it as meal or oil. So it really is, again, a Brazil-U.S. situation. And so far, both countries have been able to get their balance sheets back to zero at the end of each production cycle with the demand that has gone to China because China continued to grow their demand. But as China levels off, that becomes a different situation again. Enter renewable diesel, and it looks to me like the U.S. could continue to take a smaller share of the soybean export market as well. Then that doesn't necessarily have to be a bad thing, but we'll see how the renewable diesel plays out. So it's always fun when I'm with a farming group is to show what prices look like on a C&F basis, meaning delivered to the country. So soybeans delivered to China. If you look at the column on the left, you can see the different countries. If you look at the middle column, you got July, which is the shipment period that we're talking about. And you can see that Brazil is the second cheapest at $18.47 a bushel. We highlighted that because Argentina really doesn't have a significant number of bushels to export. So, but you can see how P&W US Gulf are higher but competitive. And we think that's mainly because you got a crop situation in Brazil where the farmers know they're not going to get as big a crop. They are not interested in selling even at current levels. And so, therefore, the offers coming out of Brazil are much higher. But fast forward to October, and you can see that Brazil runs out of soybeans, Argentina runs out of soybeans, and it's really a U.S. show. And we're significant cheaper in the new crop situation. So it's going to be interesting to see when China comes back to the U.S. I can tell you now they're buying a lot of October, November soybeans already, anticipating that Brazil will not be there for them this year. If you move over to the corn, same setup. If you look at April, you can see that it's really before the South American harvest, but not at harvest time in the U.S. either. And so Black Sea is the cheapest right now, but prices are fairly competitive along the lane. If you go to August, which is interesting, you can see that RG in Brazil will be in the middle of their harvest. And so they are significantly cheaper than either Black Sea or the U.S. And then you get into October, November, and it's going to be the same situation as soybeans. The U.S. will dominate in terms of a pricing perspective. So I'm just going to kind of switch it up here a little bit, and I'll be quick about this. But technology and labor, you're kind of asking, so how does that fit into grain prices and grain markets and things like that? It's just something to think about and look forward to is as you look at and think about your own operations, how can you be more efficient and in your operation by using technology? I think we've all thought about labor and how expensive or just completely unattainable it is and can be. How does technology potentially play into that? And I'm going to talk about digital and analytics here in a second. But this board here that in the picture is actually a wall at our headquarters. And we are managing what you're looking there in the bottom right is our Myrtle Grove elevator. So we're watching barges and vessels loading real time. And that's part of this digital supply chain we're talking about is we manage our rail fleets, we manage our barge fleets, we manage our all supply chains, whether they're in the Gulf or in the P&W right now, through that, where we used to take people to put together spreadsheets, and then those spreadsheets would get disseminated out to a bunch of people. Now, it's all right there, real time, all the time. So, significant improvement on our ability to make good decisions and have information right at our fingertips. But just on excuse me, just on people, I think it's very much pandemic based. I think this was a trend that was happening for a long time, but the pandemic just brought it on much quicker. So right now, about 2 to 3 million people that I would consider to be baby boomers retired during the pandemic. They either lost their job and just decided to retire, or they decided that work wasn't safe, so they decided to retire. But we lost about 3 million workers due to retirements during the pandemic. From an immigration perspective, the number's not nearly as significant, but immigration change in policy in 2016, plus the pandemic, has caused less immigration to the United States in terms of taking jobs. And I'll give you a personal example. We were going to bring 3 people from Brazil that worked for CHS in Brazil to the U.S. right before the pandemic hit, and they still have not gotten here. So that type of thing is happening as well. But the most alarming one is the prime age workers. Several million people got laid off, whether that was in the trucking industry or restaurant, hospitality industry. They got laid off. Some found other jobs. I would say most are back to work now, but there's still 1 to 2 million of those prime age, what we call prime age workers, that still have not re-entered the workforce. And so when will they? We don't know. I mean, all the government extended unemployment and the child care credits and all that kind of stuff ran out in December. So we'll see if that brings people back to the workforce. And this is my last slide. So what we've done, and we started this a couple years ago, first we got to get our people accepting of technology. And so we operate under what we call a lean operating model. And that is where whatever the customer isn't willing to pay for, we just stop doing. Whatever is not standard work, we make standard work. And so it's a mindset difference where there's bottom-up action planning versus top-down decision-making. So we're enabling all of our people to look at what part of the supply chain they're in or they're working in, and how do you improve that process. And so from there, I talked about analytics and digital a little bit, but from there, people that are out in the workforce looking at silos and assessing the situation or the missing a word here, but when they go out and evaluate the silos, now they're using drones. Instead of climbing up and down the silos, they actually fly drones around. Those drones take pictures, they actually record them. It's there for posterity. They can actually come back and show people what's going on. So not only does it save them time, not only is it safer, but it's better quality inspection. And that's just one example. The biggest one for us is the robotic process, or RPAs. So whatever task we do that is redundant, so if that's putting bill of ladings into the accounting system, the ERP system, that's a redundant task. And in the past, we had people doing that. Kind of mindless work. Now we have RPAs do it. So they're just basically, if you guys all remember Excel spreadsheets and the macros back in the day, this is that on steroids. And it's real easy to do. I don't think I could do it, but it is real easy to do. We've got like 60 of them now. So 60 different processes that used to be done by people are now being done by those, and those people are freed up to either go to another area to work or to supervise 6 of these at one time. But it's really, again, taking that unknown labor situation and making ourselves more efficient. And then the autonomous vehicles, we have a crushing plant in Fairmont, Minnesota, and Mankato, Minnesota. They're about 60 miles apart. We take the crude oil from Fairmont, we truck it to Mankato to be refined. It's about 60 truckloads a day. We can't get enough drivers to do that. And so we have actually applied with the Department of Transportation to do a pilot on autonomous trucks. And we would take one truck and put 2 piggybacks, 2 different trucks, not trailers, just trucks, and we would then run that oil to Mankato that way. We have a video of it. It's actually pretty cool. I mean, if the front truck weaves to the left, every truck weaves to the left. So it really is an interesting technology, and I think there's going to be more and more of that. And I think that's a really potentially big application for farms. I think about running grain carts, those types of things. So whatever we can do to be more efficient, and take the labor question out, because we think the labor situation is here to stay. And I think with that, that's all I have.
Don't go too far away, Brian. I want you and Darren and Anita to come up back to the stage up here, and we'll get you on a chair so we can field some questions. My goodness, we ought to be able to test for advanced credit over here in just a few minutes. What a great download of information. And if you've got a question or two on your own, you'll have a chance to ask that question. You can text it. Tim will field those for us, and we'll make sure that the panelists can get that. It's one of the best summaries of things that really matter, but boy, there is so much that matters right now. I'm going to start off by asking a question of my own. And Brian, I want to come to you on this. I'm one of those, we'll see if that mic is on. Is anybody controlling microphones for us there? We need to make sure that Brian's mic, maybe the mic on your shirt is working. Let's try that. No, they're both gone. We might have to pass the mic around, yeah. Having grown up in that Cold War era, what? Yeah.
You talking about yourself? Or
Yeah, myself. Yeah. They were pretty close. Looking at this Chinese-Russia coziness makes me very nervous. And what are the potentials for sidetracking our grain demand if these two countries start to get closer and closer, so that maybe China starts to rely more upon, well, eventually, thinking they're going to get Ukraine grain? What happens there? Are you concerned about that? Is that something on your radar screen?
It's something to watch. They're already buying Ukraine corn. So of 26 million tons that China bought this past year, 8 million tons of that was Ukraine. So it's just natural to assume that as Ukraine pumps out more corn, China's going to keep buying theirs if it's most competitively priced. The situation on wheat, though, is a little bit different. In this last weekend's announcement, they've also agreed now to take all restrictions off Russian wheat going to China. And that is a big deal, because Russia will export more wheat than to China. As far as them getting too cozy, I think they both have self-serving interests. I mean, I've been dealing with China since early 2000s. China does what's in the best interest of China. And I can't see where that would change for Russia. I think it was just a really opportune moment for both countries to make a statement.
To send a signal.
Back them up.
Yeah. So you're not too concerned that they'll get so cozy that they'll really back out of our grain market in any big way? They need us.
I don't think that will be the case. If Taiwan and China have a problem, I can guarantee you they will back out of the U.S. market. To the extent they can. Keep in mind, Brazil goes to a zero carry on its soybeans, and they need about 30 plus million tons of our soybeans to get through the year. So it's a love-hate relationship for sure.
Relative to that report a little while ago, Brazil, the bean estimate by USDA was dropped to 134. So that was down 5 million tons. They still need to go more, right?
It's coming.
And they took corn down to 114. Brazil corn down to 114 million tons. That's dropped a million. They left Argentina soybeans at 45 million tons, down a million tons from the previous estimate. And they took Argentina corn they put it at 54 million, I believe, and that was unchanged. So,
yeah, I think those are probably not. I mean, that's typical of the USDA to
be cautious.
Go a little bit slower, yeah.
Yep.
But our guys that are in Brazil and are experiencing the harvest believe it's under 130.
Let me ask one more question before we get going too far. Darren, we've had so much talk about infrastructure, investing in infrastructure of our highways and our waterways. What about that infrastructure of pipelines? And many of those are old. Is there any federal money that's going to be going into these at all, or are they just going to continue to deteriorate now?
That's a really good question. I know that we've opened up maybe several new pipelines in the last year, but whether we continue to get federal money to fund these is going to probably be decided after this November election and obviously in the November 20 or in the 2024 election. But as it is right now, I just don't see the federal government pumping a lot of money into the fossil fuel structure.
To help us understand a little bit, I mean, if you look at a pipeline map of the United States, there are hundreds of them, are there not? I mean, obviously the one that you pointed out was high profile because it had people lining up at the gas tanks in 20 states at the gas pumps. But when you look at the whole infrastructure, it's huge.
Oh, it'd be amazing to see a map sometime. I mean, they just go everywhere east of the Rockies. I imagine if we have a major pipeline problem and we're still in a big fix for natural gas to make it into Chicago, I'm sure the federal government will probably come in there, at the cry of the government or the governor and say, fix this thing, or I'm going to lose votes. That's basically where it's coming down to. And that's, a lot of these politicians have already seen that, hey, look, I can't even get out there and politic unless we get rid of some of these travel restrictions and mask mandates because the people just don't want to listen to us. So I think, it'll take a crisis to make a move.
Anita, looking at that NH3 demand last fall, how do you handle that going forward? Do you plan to have that kind of demand almost every year now, or do you say that's an aberration? From a co-op standpoint, how do you prepare for that for this fall going forward, for example?
The interesting thing on fall ammonia is typically it's weather. derived, and so
Right.
when you look at how fall, and it's not just ammonia, P and K, the more fall application opportunity you have, the better off your rates go. So it's tough to plan for that big of a fall, which obviously can cause some logistic constraints, price movements, those types of things. Can't plan for that every year.
Anybody out here have a question you want to ask? Yeah, Tim, you got something for me here? With grain markets going crazy and inputs following suit, how could a grower protect himself, herself from the bottom falling out? Well, I guess,
Does it say who it's for?
I think you should answer that one.
Okay. What I have seen a lot of our retail owners do with their growers is more connecting the grain with your inputs. And as you're selling or marketing your grain, buying your inputs, being more locking in the spread or the relationship between grain output and input versus trying to swing for the fences on grain and buy your inputs cheap. It's more of a risk management strategy in these types of environments that I have seen more of that definitely over the past 18 months.
veg oil demand by the airline industry. I want to get Darren, you and Brian both to weigh in on this. I mean, airline demand is massive, is it not, as a fuel consumer globally? Now, I recognize we've pulled back flights, there aren't nearly as many, and you have to wonder going forward. The flight I was on yesterday from Raleigh to Chicago had 50 empty seats on it. And, well, it was a Tuesday, so that may have been a little bit of that factored in there, but the business flyers are not coming back. Still, how big is this vegetable oil demand globally to keep planes in the air? You want to take that first, or Brian, go ahead. You got it, Mike.
Yeah, I mean, Darren can maybe weigh in on whether we're talking about soybean vegetable oil or, I mean, I know there's sustainable aviation fuel projects working right now. Some of that's based on ethanol versus vegetable oil, but, overall, again, it's just gonna take 2 or 3 more states to pass the LCFS, and you're talking about another 1 to 2 billion pounds or billion gallons of renewable diesel that's going to need to be produced. So the demand is quite honestly endless if these states continue to pass these LCFSs.
Brian gave a great presentation. I got to tell you, I really love it. And he was showing you, the strong soybean oil demand that they are projecting to use for biofuels. Think back to your ethanol days, how that started and took off. When I look at the numbers that Brian shows, I'm thinking food or fuel, and I'm sitting here thinking, there's no way this is going to happen. Soybean prices, if they continue to jump as they are, you're going to have your political screamers out there. And when they get on that social media, it causes issues. I could be wrong now, but you don't know. I mean, and then you're going to produce all this oil. Now we're starting to talk about jet. Let me just go back to that. Jet fuel demand is going to increase, and it's going to probably increase substantially because it still has not quite caught up with 2019 levels, but it's going to. And then it's going to take away from your distillate production a little bit as well. So things are going to get a little bit more expensive. Things are going to get tighter. People are going to travel this summer. Now, you brought up a great point about business travel. I think it'll start to increase now as people want to get back to normal, especially if these Canadian truckers, force the issue here and if Canada has to start lifting these restrictions, the U.S. will probably have to follow suit, right? So then I think you'll see bigger travel demand, more truck traffic demand, more jet fuel demand. But man, I just don't know where to go with this soybean issue because you'll have to have $20-some beans, and then you're going to produce all this meal, and you're producing it for all the oil. And then you get a food to fuel issue. So I don't know how that's going to balance. And, I mean, Brian, you may know how that's going to play out.
No, I don't think anybody knows.
But to me, it's a very hard math problem to figure out. And then if you want the extra 13 million acres, okay, we're going to start having electric cars, right? So we're not going to have as much gasoline. You're not going to blend the ethanol. So, we could take it away from corn, maybe?
Yeah, I look at that when you think about substituting diesel with renewable diesel, right? I mean, But every time you crack a barrel of oil, you're getting what, about half diesel, half gas?
23% diesel, 40% gas.
Yeah, so I mean, you start to eliminate, I don't see in the near future anyway that they'll have electric semis, to your point earlier, but as you replace diesel with renewable diesel, there is no gas, right? It's 100% diesel. So, there's another reason why they want to continue to push this, but yeah, the trade-off for food is you use other vegetable oils. And so you could substitute palm oil, sunflower oil, those things, but they run out of quantity as well. So it is a real dilemma. I mean, it feels real because the refiners are converting their plants because without converting them, they're worthless in California, right? So I mean, it's a really interesting situation. And you're right, it is a lot like the ethanol back in 26, 27.
But yeah, if you're talking about background, well, I'm thinking about 2013, the food versus fuel debate that surfaced then, with the drought that we had and everybody looking at ethanol. I mean, that seems like it's going to be that in retrospect may be very tame compared to what we see, if I follow you correctly.
What I think is interesting though is this people that cry food versus fuel are the ones actually making it happen.
Yeah, exactly.
They're the ones that are creating the fuel piece.
But will they realize that?
I don't know.
What happened to all of the anhydrous ammonia production that was planned at one time, and plants that have been on the drawing board in the past, Anita? And I remember hearing some talk about a Tuscola plant. Is that coming to pass? Or what's happening?
When you look at new plants, and you see years like this year where you see tremendous margins in manufacturing, and I'm going to guess it's the same no matter what business you look in, that's when you start to see new entrants into the market, right? Whether that's new plants or whatever the case may be. At one time, we were tracking, I want to say over 40 publicized or announced new production, and very few, I'm going to say less than 5, came to fruition. Part of it's financing, part of it's environmental. I mean, there's a variety of reasons why, but we've not seen that kind of new production. You see more debottlenecking at some of your current plants across the North American market, but you're not seeing new plants come on. But it is something to definitely watch. If these margins continue, there would be an incentive from a manufacturer perspective to increase production rate at those margins.
In terms of adding to capacity, in each of the 3 categories that we've covered here, would you give some guidance to the producers about what they should do relative to on-farm capability of storage? Should a farmer be thinking about that in some way on his or her operation with all of these pieces in play and working with the co-op, to make sure that they've got that supply when they need it of the inputs, for example? But what would you say? Let me start out, with you, Darren, to begin with. What would you say in that regard?
I'd probably add a little bit more storage, fuel storage. I think when things, if they continue to get tighter, and as everybody's screaming for the diesel fuel at once, as you get into the planting and harvesting season, you could find that, and Garrett, head of Premier's Petroleum Department, even said, look, Marathon just called, they're out of Robinson, Indiana, and said, hey, look, we're down for a couple days, they're not shipping out of the Champaign terminal or others. You're going to run into these supply constraints. I would probably add a little bit more diesel fuel to maybe get you another 2 weeks out, or maybe a little bit further. As far as grain, look, the co-op's got to be able to make money, right? The problem with the grain markets right now is they're all inverting. When you've got an inverted market, just like you do diesel fuel, you're not making any money storing grain with carrying charge markets. So they're going to have to be able to make it up with basis or other type fees. And you're going to have to be able to support those kind of ideas when you call and make a comment, hey, look, when your price a little bit better, well, if you're going to keep this co-op going in an inverted type markets, when the world's at these shortages, they're going to have to make it on throughput fees. And that's basically what you're seeing with everybody these days in about every type of business. And I probably went well over my, what you were asking.
No, perfect.
But, hedge does. The floor could come out of these grain markets just as fast as you could see the floor come out of them back, a couple of years ago. China and Russia could just walk away from us both in some political poke and corn and soybean prices dropped substantially. You know, my biggest fear is what happens to us in the future, because your whole livelihoods are played out on social media. They can make or break your business in a 5 short days if everybody gets on the whim. I mean, they're sitting here talking about all the CO2 emissions coming out of cattle, right? Oh my gosh, cattle are so bad, you know, it's gonna hurt feed demand. Don't eat steaks, you know, and all it takes is one soccer mom to continue to drive through Burger King, right? And as she's going, she orders her kid the soy burger, or the ultimate lab-grown cheeseburger. And you and I couldn't stand the taste because we're used to eating real meat, right? But the kid doesn't know any better. He gets used to it. Well, then it's 1 burger, then it's 4 burgers. Now it's 25% of their volume. Well, there starts weakening up the cattle demand, right? It's there. And if we continue to lose gasoline demand in the future to EV cars, now 8% of the cars globally this year were EV cars, all right? And believe it or not, though, that's a pretty substantial increase from just a couple of years ago when it was 2%. They're growing. You're going to see more of it. But if you lose that gasoline demand, what are you going to blend your ethanol with? So there could be a 1-2 punch. You got to be careful and maybe don't stand out there naked long corn as long as you used to, or on that next crop. Hedge it, buy some put options, do some fixed forward contracting, control your upside risk, control your downside risk.
Or maybe that soccer mom runs a big investment fund and she says, okay, Burger King, here we go. And that could be happening too.
Yeah, there's nothing wrong with soccer moms.
How do you like the way I teed that one up for you? You can tell I'm a father of daughters and a grandfather.
More of a volleyball, but fair enough. Strictly from an agronomy perspective, I might be a little bit more old school, but I look at it, the company you all own in Premier and United Prairie have done this, right? They've invested locally. They've put up the storage to make sure you all have the supply you need the day you need it. They've got the trucking. There's not many that have the kind of capacity that UP has. And again, I'm more agronomy focused. But that's where I would lead. Do I think there needs to be on-farm storage as much on fertilizer? No, because I think United Prairie's done a heck of a job making sure that's covered for their owners.
Brian, we've added a lot of on-farm storage in recent years.
So I'm gonna do what my grain background would tell me to do, and I'm gonna hedge. I think there's reason to have some on-farm storage. I think there's in a wet season, it probably makes sense to dry your corn at home. You need some storage to do that. But I agree with Anita. I mean, the co-op system, your system that you own, does a pretty good job of handling that grain. And if you don't bring it to that co-op at harvest time, there's a good chance you don't bring it to the co-op, unless there's a shuttle loader or something like that, because the markets are going much more direct nowadays. So I do think there's some value in having it. I mean, I farm a little bit with my brother and my son, and they just built a 60,000 bushel bin, but they had no other storage prior to that. So this gives them some flexibility to be able to harvest quicker out of the field, you know, those types of things. But by and large, for what it costs to put on-farm storage on there versus what the markets and the carries that you're able to get year in, year out, I think the co-op's invested in that storage, and I'd be trying to find a way to use them as much as possible.
Brian, while you have the microphone, and since you cover so much geography across the heart of the country, what do you think about the corn-bean mix as it is right now, as it appears from your viewpoint? Is there much tug to take place yet?
It appears to us that there's actually going to be more corn acres. So our analysts and research teams are talking about more seed being bought, more agronomy put on the fields and stuff like that. So today I would say I'm not expecting a significant larger number of soybean acres. Possibly we get surprised with a few more corn acres. I don't know, Nita, what do you think?
Yeah, I would say the same. From a central Iowa perspective, those of you who remember the derecho that came through, we had to do beans last year, and so now it's going to be a corn acre this year, so we're almost seeing the same thing where maybe not chosen, but due to weather and Mother Nature, it's going to be corn acres in a lot of spots.
Very good. Anybody with a question you'd like to ask? You've all got strong voices, so if you have one, feel free to just yell it out. You've never been shy before. What about inflation in the nation? It's going to be such a big deal, I think. And is the threat even understated a little bit? You know, we've been talking about the possibility of 5 increases as this year goes on, as the Fed acts. And what role will politics play in that? Are they going to be timid to raise rates, or will it be aggressive? Again, some of us recall back in the 1980s and what took place at that time. And the prime went so high, and the effect that it had across the board, and the effect on the strength of the dollar as well, which you folks talked about.
I'll let these two gentlemen answer as well. I don't know how it couldn't be a concern moving forward on all those spaces. Whether it's inflation, I look at that, the biggest thing I see is people. The more own retailers I've talked to, the biggest concern they have is labor. Finding guys to put in the applicators, running forklifts, that's gonna be a huge issue that I don't know. I'm curious on technology where it could go, but there's a certain portion that we like to be face to face, right? There's a certain element of people to people. That's my biggest concern is the labor piece that inflation absolutely hits nail on. The politics, it's fun for me to watch, but
Yeah.
I can't even outguess it anymore, to be honest,
Right.
of what's gonna happen next.
This is a really complex question because there's so many bouncing balls involved. As Brian, and he's probably can answer this a heck of a lot better than I can, but so much money has been loaned out at super cheap interest rates around the world. You don't hear this in the news, but Europe and China and these other countries don't want the U.S. to start having to raise rates. As Brian mentioned, they're talking about 5 potential rate hikes during 2021, early 2020, or 2022, 2023. I'm hearing as many as 7. The first one will probably be 0.5% in March. Ouch. I mean, think about all these revolving mortgages that will be coming due in the next, year, 3 years, 2 years, and all the businesses that sold all these bonds at all these super cheap interest rates, and now rates are going to start going up. It's going to cause a contagion of probably debt problems. And maybe you can answer this question, but I saw this a week ago about how many companies on the S&P can no longer even service their interest debt. Did you read the article?
I didn't.
But I was stunned at the number, and it was, I don't know, 12%. I don't know. I can't remember the percentage, but it was a big enough number that it shocked me. All right, so say we start raising these interest rates to slow the inflation. I do look for inflation to come about. So what's everybody going to do before the interest rates go up? Let's go buy this product, right? It's going to cause probably one more leg up in inflation because the higher interest rates are going to cause products to even go up higher. You're already in a labor shortage. You're already starting to get into a supply and distribution shortage. So once they start hiking rates, first thing you would think is it'll cause the market to go down, on a stock market or in such. But maybe we factored that in. Was that what that sell-off was in the stock market back in December, January? Because everybody that's on the know already knows, right?
Yeah.
Okay. So the question is now, if you've got any long-term finance debt of farm ground, maybe you want to go fix that rate before they continue to possibly come in here with 5 to 7 hikes over the next, 12 to 24 months. And the first one or first 2 might be 0.5 percentage points. I don't know. That's just what I'm hearing out in the street.
Lest we forget, the second highest cost of doing business back in the 80s was the cost of money.
The cost of money.
And so it's a risk, as you point out, it's a risk out there
So
for some.
if all these other countries also borrowed money in terms of dollars, and now they're going to have to go pay some of that debt off or refinance, now they're going to have to come back and get dollars, right? So that's when it's going to force the dollar up. If it strengthens the dollar, it's going to hurt our exports probably. I mean, we're already importing everything under the sun from China now. I think our trade deficit last month was $1 trillion, new record. Is that 2 months in a row? Anybody know? It's almost embarrassing, how much more we import from China. I think 98% of all of what we used to make comes from China now.
Yeah.
Even your pharmaceuticals.
It's chilling, yeah. Brian, what do you think about inflation? What's your view?
No, I agree with what Darren and Nita said. I just think when you think about it more long-term, a lot of money was invested in companies that didn't make money. by venture capital firms and things like that, but it was okay because the interest rates they were getting was probably 1% or whatever. You can risk 1% money, right? But when you start to get, let's say we get up to 3%, 3.5%, that isn't going to be as much fun, and you're not going to be willing to wait impatiently for this company, this startup or whatever to make money. So I think my biggest concern about what the Fed is likely to do is it's going to slow the economy. And if you look at the balance sheet that we have and the debt that we have to pay off monthly, just interest, and you slow the economy so the GDP's not growing at the speed it was, that's another recipe for disaster, right? And pretty soon we can't service the debts unless we print money, which is inflationary, so it becomes a really bad cycle, right?
What about, it's the topic of the day, but it probably, Brian and Anita, this may be more in your areas, but if you care to as well, Darren, weigh in. Supply chain issues. I've had some supply chain experts say, well, maybe by the end of this year, maybe by the fourth quarter, first quarter of next year, some of these things will be worked out. Do you agree with that? Do you see that? If not, to what degree could it affect transportation of grains, transportation of inputs, fuel? You know, that's a very complex issue too, because it's not just ships off the coast of California. It's part of the trucking industry picture as well. How do you view that? What do you think that could mean in terms of agriculture?
I don't see the supply chain issues over anytime soon. To Neil's point, it's labor. That's the biggest part of that issue. You still have COVID going around, so I mean, on any given day, you're working the dock and 10% of your workforce could be out because they've tested positive for COVID. So I think until we get that part under control, we're not going to be able to solve the supply chain issues. In the grain side of the business, though, it hasn't been as pronounced as we were worried about very early on. It's more in the trucking side. It's hard to get truckers. It's happened a little bit in the rail side where the railroads aren't performing as well as we would expect them to.
What about container shipments of grains? It's kind of a small piece, but it's high
It's actually
value.
a large piece though, and it's bad. It's really bad. And again, it has to do with getting the workers at the yards and things like that. So those things I just don't see changing until we get people back to work, or until this COVID thing is behind us, and I hate to say this, but we start treating like COVID's the flu or something like that, right? And I don't know what side anybody's on, and it's a political topic, but it's just, if we're gonna continue to wear masks and have to be vaccinated, or you can't do this or that, then we shouldn't expect this to go away.
Okay, Anita, would you like to weigh in, please?
I'd say much the same, specifically on fertilizer. I do think most of the product is here in the US, so it's more of a logistics concern of getting the trucks in the right spots. Would be my bigger concern heading into spring season.
Will there be some challenges in that regard, though? Well, I mean, if the producer doesn't have it right now.
Yeah, I think that's where the pre-planning comes in, right? I think that's where working with your agronomist or whoever that might be is putting that plan in action a little bit ahead of the game. I think showing up the day you need it might be tougher, and that's not, I'm gonna say that's not a short-term thing, I'm gonna say that's a longer-term thing, where I don't think the labor shortages are going away anytime soon. And it's going to be more consultative partnership relationships, I think, as we move forward of, hey, we're working together here. Here's what I need. Here's what I'll make sure I have supply for you. More of that type of relationship.
Don't wait till the last minute. Stay in communication, you're saying.
Yes. Yep. Versus last minute,
Yeah.
show up and I need it kind of stuff.
Aaron, we're going to let you have, oh, wait a minute. Brian wants one more
I was
chance.
just
here.
gonna throw a personal example.
Please.
So my wife and I are the king and queen of waiting till 2 days before Christmas because we want the best deal. And, usually you can get pretty much whatever you want. This year, first year ever, we were buying, she was buying, I don't necessarily get into it, but we were buying 3-4 months in advance just because we were concerned that we weren't going to get it. So that's how drastic I think things have changed in our supply chain situation.
You brought up a sore spot. Mr. Armstrong didn't have the propane tank filled like he should have about a week ago. It was getting chilly in the house in more ways than one, I want to tell you. Whew, thank goodness that guy pulled down the lane after dark. Darren, wrap it up for us, sir.
I don't really see the supply and distribution chains being alleviated right away. it would really help if these Canadian truckers could win this situation, because I think it'll really also help alleviate problems here in the U.S. and maybe some of these other European countries that are so tied closely with Canada. Now, you know, I mentioned to you, here's what you're running into. It's like I mentioned to you that the Indiana Petroleum Jobbers Small Town Bank Board would not approve a loan because they're in that woke fashion, you know, of, man, you know, we don't want to loan money to the fossil fuel stuff and expansion. But it would also help if our administration come back and ease things up just a little bit, so that even Volkswagen and some of these other car manufacturers would say, okay, we're only going to have 50% of our cars be EV instead of, you know, cutting it out and making it 100% come 2030 EV. You know, that would ease a lot of the constriction that you're seeing in the petroleum side of the industry. And and at the bottom of that example that I gave you, I didn't read the other one. I had another petroleum jobber in Texas. He's what's called a wet hoser. So he goes around, he fills up these large construction equipment at these construction sites. And he's 67 years old. He was ready to have his business sold. He was just waiting for the head of the guy to come back from Europe, and it was the world's largest cat dealer, and they own a lot of these different petroleum jobber type companies, because it used to be a great add-on to selling the large equipment, right? Hey, I'll tell you what, you buy 50 of these diggers for that crane, you know, for that mine or all this lumber business. I've got a petroleum company that's also going to supply you the fuel. We'll check the oil, we grease it, we'll have it ready for you to run in the morning as well. And you know, so they also supplied fuel to these guys, you know, and it helped them sell the cranes, the diggers, the payloaders, right? Well, the guy, the head of the largest cat dealer in the world comes back from Europe, cancels the sale and says, we're focusing all now on clean energy products. You know, the guy's it took a gut punch, so to speak. What am I going to do now? I'm probably going to have to wait another 2 years to try and get this business sold, and now it's getting more difficult, especially with these kind of stories get out, you know, here in my local area, that such and such backed out when we thought we were on the line to sale. That's not going to help your supply and distribution situations, right? Nobody's going to want to put money into it. But I got to tell you, there's going to be an awful lot of money to be made in the petroleum business if you're in the petroleum business, because people are going to call up and they're going to need it. I myself, just bring it out, you know. I'm not going to dicker around trying to go, you know, call 5 different guys, you know, when I know this one will always be able to supply me, because next load, that other guy may not be around, or not be able to get the fuel. You know, as things get tighter, I'm seeing some of my petroleum jobbers in what I consider making mistakes. They're dropping some of their long-term customers to go jump over here and immediately supply something else, you know, because they're calling for backup diesel fuel. And, you know, now they pulled their trucks away from a normal supply type customer. You know, might even be Cummings or somebody in Indianapolis where they've got all these backup generators they need to keep running. So, you know, then they pull their trucks away from somebody else.
What great analysis. Oh, Anita, you're going to get the last chance.
One thing I
You're
wanted
all
to
in
say,
and all done.
I'm just sitting here, and if I'm in the audience, I'm like, holy crap, that's a lot of bad crap. I look at it, I'm going to put a silver lining on it from a perspective of volatility comes opportunity. And I don't care, I'm going to speak a little bit outside my school, but whether it's grain or fuel or fertilizer or crop protection, no matter what, the volatility comes, and it will come, and you can't predict it, but there's opportunity in that. And that's where you can be profitable, or maybe it's a resource allocation. I don't know what the situation might be, but I do think there's tremendous opportunity in these cycles. If you're looking for them, if you're ahead of the game and pay attention, have good partners like UP and Premier to work with you on these things, I think there's tremendous opportunity.
Well, that took care of Max Armstrong's close to the panel today. There it was. What a great job. You have had a tremendous opportunity here today. Thank you. Aaron, Anita, Ryan, we appreciate it so much. I'm sure they'll be around in case you have another question or two. I also don't want to forget the fact that there's an opportunity after lunch today to get a little bit acquainted with the app, the new app that the co-op has. So you can take a look at that, maybe see the options there, see how it could work for you too. The thing that strikes me, having listened to this panel, and I hear a lot of meetings, I've been to a lot of them, of course, as many of you have over the years through agriculture leadership channels. You will not hear a better analysis at any agriculture national meeting this winter than you just heard here this morning. And getting it through the perspective of your local co-op that's a partner with you. In all due disclosure, I grew up a co-op kid. We had a co-op tractor. Dad and Uncle Frank planted co-op seed. If the co-op, we had a co-op freezer. If the co-op had underwear, this kid would have been wearing them back in the day. So, and they knew the value of the partnership then, and many of you do too, obviously. Hope you have a great planting season and a great growing season. Be careful, and those of you who happen to catch our broadcast on a regular basis, thank you. That means a lot to us, and especially if you can pass it along to some of our advertisers. Keeps bread on the table. Have a good day. Thank you.